Good evening, everyone. Welcome to the monthly IBD Meetup overview. My name is Roy Maddox. Wes and I are hosts and the facilitators of this monthly webinar. We've got some good news to share with you tonight. Trader Lion, beginning next month, is going to host this presentation, and they want us to monthly present content that they think might be useful to your users. So we're excited about that partnership with Trader Lion. This meetup is sponsored by Investors Business Daily, and we are one of the largest meetups in the country with over 2,300 members. I'm also the chief market strategist and portfolio manager of a company here in Charlotte named Integrated Financial Strategies. And Wes, who's my partner and son, is also the co-portfolio manager that we assist in managing portfolios for individual investors in our occupation. I've been employing CanSlim techniques for 35 years now over many market cycles. If you're not on our email list and you would like to receive our comments, please respond in the chat, and Wes will provide the link shortly. We're a private group of 2,300 investors who know with 100% certainty that the ability to change their financial lives and financial destiny is possible by identifying and purchasing and owning a true market leader through its run. And that run typically is 8 earnings cycles or about 104 weeks. Many of us have done so. We're like-minded individuals, and we both use fundamental and technical analysis in managing our investments. We don't believe in a buy and hold strategy. Simply stated, there are times to be 100% invested in the market all the way, and there are times to be out of the market. And it's important to distinguish those when those times occur. So we don't believe a buy and hold strategy is the proper strategy in managing our investments. All of us tonight aim to educate and connect with each other in this vibrant online community known as the Meetup, and that we are able to use through the internet. So we're thrilled that we're able to share this information and our presentation really all over the United States tonight. We'll have members and attendees from all over the country in the Meetup tonight, so we're thrilled for that. Tonight, and always in our Meetup groups, we focus on a combination of technical and fundamental factors featured in the book, How to Make Money in Stocks by William O'Neill. We utilize IBD's educational support that can be found at investors.com often, and members hone their investment skill and work to master the intricacies of the stock market using these tactics and strategies that begin in the book, How to Make Money in the Market. We cover many CanSlim concepts in these meetings and utilize information that's designed both for beginning investors and also experienced investors. So much of the discussion tonight will be centered around a broad array of subjects that will facilitate investment decisions. And we primarily use MarketSmith and investors.com for our research. Tonight's agenda will be divided into 2 sections. In the first 20 minutes, I will provide an overview covering the market's current condition with some timely macro concepts thrown in. And Wes will then take us through our slide deck that we will email you later. We will then take a break, stretch our legs, excuse me, and then come back and discuss really the most exciting part of the presentation. And that is identifying and discussing what we think are true market leaders in the market today. And we think we've done a great job in identifying those last month and the prior couple of months, as well as tonight. If you're a novice investor, welcome. Don't fret. Some of our most successful investors have no formal education in the stock market. They but because of their passion and totally immersing themselves in the content in the market, they've become quite established in terms of their investment prowess. When I met Bill O'Neill and David Ryan in 1988 as a rookie at a seminar in Houston, it changed my life forever. I knew that I was in the presence of greatness. That motivated me and inspired me. I hope that Wes and I can motivate you, educate you, and inspire you tonight. Remember, this is America. Capitalism and innovation prevails, and anything is possible if you apply yourself and want it bad enough. So let's get started. Okay, the market summary. After completing an extremely choppy and challenging year in individual growth stocks in 2023, we began 2024 with a sharp pullback with several short-term gyrations. We can expect more of the same in 2024. In fact, tonight we want to filter out through the noise as the charts reveal the total, complete, and accurate picture of what's going on now and what presumably might occur this year and in the future. As we prepare for earnings season, beginning with the banks starting Friday, it will be an opportunity to discriminate and find the powerhouses and real leaders in the market. We will talk about some of these tonight ad nauseum. Perhaps the most exciting piece of information will be the inevitable approval of a spot Bitcoin ETF expected as early as tomorrow or the next couple of days. This year will be certainly focused on artificial intelligence, innovation, biotechnology, and companies that have a product that may change the way we live, learn, and interact with each other on a global scale. After almost a 3-year bear market in growth, measured from the peak of the last bull market in February 2021, the slate is clean and setting the stage for a super cycle resumption in CanSlim in 2024. We hope you will join us in this pursuit this year. Most CanSlim practitioners are worn out or sold out. Those of you who understand that strategies rotate should have an unbelievable ride in 2024. The current market is an uptrend with 3 recent distribution days. But we are in position to retest the highs sometime this year, hopefully sooner than later. Interest rates have dropped from 5% to 4%, fueling this run in the bond market. And inflation continues to moderate. In fact, the Fed funds futures model predicts the first rate cut by the Fed in the spring or summer. It's all about the economy now, and the labor market should support economic growth, which should lead to excellent earnings prospects in many companies. Tonight, Wes and I will take you on a journey of our slide deck to provide perspective and context, which will assist, well, all of us in putting the pieces of the puzzle together, which describe a coherent investment strategy and approach. With that, let's get started with the slide deck. This is a little bit about our Meetup group. Next, take a look at our disclaimer. Be sure and read this. We wanted to also point out that tonight's presentation by no means is designed to provide advice on an individual basis. And tonight's information that we share should not be construed as investment advice. So CanSlim, what are CanSlim stocks? And we urge you to study the book, How to Make Money in Stocks. Wes and I do this at least once a year, and I've been doing it annually for 30 years, to which describe the acronym and what it stands for. The seven letters represent really the most important elements that go into the success of a successful stock market, a stock, according to Bill O'Neill. He determined those characteristics from decades of studies of the biggest stock market winners in prior bull markets. For those of you that do not know Bill O'Neill, he's legendary in our business, and was a legendary trader, a stock market wizard, and his input has allowed many people to change their lives over the subsequent decades. C stands for current earnings. One of O'Neill's important findings was the power of high earnings growth. Every winning stock has it, and research specifically found that at least a 25% earnings report separated the winners. Wes and I, and many of you, we're looking for stocks that have triple-digit earnings growth. Those have been among the most powerful companies in the past. So 25% is really the beginning bottom of what you should be looking for. Now, annual earnings. Bill found that a fast increase in earnings can be short-lived, and that's why he found that stocks that had 25% earnings growth over the past 3 years demonstrated exceptional performance, and they were often market-leading candidates and true market leaders. So companies that have annual earnings growth for more than 1 year tend to have staying power. That's important. The N stands for new products, new trends, new highs. I love this aspect. It's history's breakthrough products that provide new services that fuel the stocks, powering high to new highs that describe true market leaders. Some of those, of course, are Apple, Amazon, Tesla, Netflix, Priceline, which is known as Booking now, and so forth. Those are the companies that we're trying to identify in the current market cycle. The S stands for supply and demand. And supply and demand and volume is important as stocks break out from pivot points and bases and have accumulation. Accumulation, as measured by volume increases, are one of the most important criteria in determining when the stocks launch out of the base phase into an advanced phase. Leadership, L, stands for leading stocks. Bill found that the number 1 or number 2 stocks in the leading industry groups were important to do work on. Many of the leading stocks and true market leaders are in the top 40 industry groups, so that's important. The I stands for institutional sponsorship. That's important because you want to have Wall Street on board. You want to have many buy reports from Wall Street. You don't want a company that has many sell reports that's having the wind in your face. So you want to have Wall Street at your back. And finally, M stands for market direction. Market direction is really the most important ingredient in CanSlim because 3 out of 4 stocks go down when the market's in a decline, while 3 out of 4 stocks perhaps may go up when the market's in an uptrend. So that's important to understand if the market is in an uptrend, a downtrend, or under pressure. And simply stated, we think, we think, in our opinion, that an investment process should consist of the technical indicators, fundamental analysis, and also macroeconomic analysis. Those are the three parts of your stool that are crucial in considering when you describe and when you develop your investment process and develop an investment strategy. The technical factors may be things such as the moving average convergence divergence indicator, price phase, stochastics, point and figure, rate of change. But we think one of the most important concepts, and really CanSlim investors are trend followers. It's important that the market and individual stocks are in an uptrend. That means most stocks should be in a position where the 10-day, this is how we do it, the 10-day EMA is above the 21-day EMA. That's a short-term signal. That means when that occurs, that stock or the market's in a short-term uptrend. From an intermediate term perspective, we want the 21-day to be, and that's the EMA above the 50-day simple moving average. And finally, from a long-term perspective, we want the market and individual stocks to be above their 30-week moving average. We have found in our work that that's significant. Tonight, Wes will take you through a number of concepts which provide you information of where the market is today in terms of the health of the market. He'll talk about breadth. He'll talk about sentiment. And we may touch on ratio analysis as well, but we think it will be quite useful to examine these technical indicators to get an idea of the health of the market. We think that's crucial. And again, this is just a slide with some additional information regarding fundamental analysis and the information that you can get from investors.com and MarketSmith. And of course, macroeconomic analysis. We actually use a program, well, not a program, we use a service that's called Hedgeye Macro, and Keith McCullough is the stem winder there. He's an economist, and we think that knowing the background, the overview with what's going on with the economy is useful, in fact. And Keith measures and maps the rate of change of global economies across growth and inflation. He plugs that data into a predictive tracking algorithm to generate forecasts. And once you have a forecast, then you can determine where growth and inflation and where policy should be. And that information may be utilized to suggest asset allocations across all these four parameters that he calls quads. So you can reach him at hedgeye.com for additional information. So without further ado, let me turn the program over to Wesley, and Wesley will take us through the slide deck. And then after that presentation is finished, then we'll take a break, and then we'll talk about individual stocks. And we have a lot to share with you regarding what we think are the true market leaders. So Wes, let me turn it over to you.
Great, thank you. I'll share my screen now and give you the... So my power went out today, and if it happens again, which it just happened, I have a contingency plan, but it might take me a few minutes to get up and running. Roy, can I get this?
Yes,
I still can't.
Let me stop sharing.
Yeah.
There you go.
Thank you. All right, so I'll go through some of these things, and I won't, talk on the January effect, unfortunately, but I'm sure you can find some commentary there if you care. But today I'll look through some of the things we typically look through, and I'll start by looking at last year and just see how that kind of compared to a typical year. This is in the top, well, I guess 25% or so of returns last year in 2023 for the index, the S&P 500. So, it's interesting to see that, obviously, and especially because it was so top heavy. That was similar to 2021. That was also a pretty top heavy year. And I have some stats saying 72% of stocks underperformed the S&P 500 index. And most of the mega caps are what led that charge of the 24.2% increase in the index. Amazon, Apple, NVDA, Tesla, and some the others. So 2023 clearly a good year of returns from an index perspective. And we're going to look and say, this is a Carson Investment Research. I mean, I did check these numbers, calculate these numbers, but This is something that Ryan Dietrich put out, and always his comments. And so he looked at, okay, we just had a 20% year in the S&P 500. What's going to happen next? And you can see it's pretty mixed, where there's still more, I think, positive years than negative years, but you're not going to replicate the returns in the index necessarily. This is the S&P 500. And you can see that only a few times after big gains did you see another year of 20% plus returns. You see that 5 instances over here. And so we're going to look at this and we're going to say, okay, that maybe doesn't look too positive. However, when you look at what we think is going to happen under the surface, it's going to be small caps and mid caps. And largely because of this, for this reason, right? We know that the first year that we just had this big 20% year, we know that it was led by the mega caps. Well, the only thing next to happen then to find superior returns, people are going to have to look elsewhere, we think. And we'll show a couple of charts that show, why we think uh, the long-term outlook should show that we're turning meaningfully, with some of these small cap indexes. Okay. And here's just a look at, I guess, the election cycle. I thought we could take a look at this again, because obviously it's an election year. I'm sure it'll get spicy by the third quarter with everything, but it just shows you that the first half of an election year is often directionless in the indexes too. So, that's something to keep in mind, where I guess people, I think this is interesting because it's kind of a natural expectation that you see, right? Like you see in midterm years, election, people get worried. People, are not sure. They just want clarity, right, on the political situation. And then the midterms happen and we're off to the races again. Well, same thing in a typical election year. You see this sort of similar behavior where you're directionless. People are waiting for clarity. It's just, the markets just don't like uncertainty, right? And a lot of times you have such polarizing views that, it becomes impactful for what policy might be in place. And like, right, for Trump, it was obviously the tax cuts, and people were just unsure about, if that would be able to be implemented ahead of his election. And with Biden, it was a lot of the green stuff that was, the Green New Deal thing that he signed and all that. So there's definitely policy implications, and uncertainty is never a friend of the market. So something to keep in mind, our typical year. Last year's seasonality was very, very like close to a typical year, and that was interesting. We may not see that this year, but keep this in mind. It's an election year. And Roy, I was actually going to let you talk on this. This is something I know you had suggested to put in, and you want to comment on what we saw from this is Siavaco Capital.
Yes,
They have some
Shavako,
good research.
sure. Yeah, this is a slide that Shavako Capital has provided, and he's looking at the long-term trend in the market. And most of you are aware that there's a difference between a cyclical and secular trend. And what basically Shavako Capital is basically projecting that we're in a secular uptrend that's been persistent, and it's going to continue another 10 years. And then you can see with what's happened in over the past decades in the past, just a bit of information that provides, I think, useful background in terms of what may happen, but in the future. But a lot of this is based on demographics. So you can cite Chavaco Capital. You can go to their website, and they actually had a presentation on it last Friday.
Excellent. Okay, and so we'll go through this. This is the oscillator. We were talking about this the last couple of months too, and so here we are, the third month. Just wanted to point out this is our favorite overbought and oversold indicator, and we were persistently overbought for 2 months, November and December, and so everyone was kind of calling for this pullback, waiting for it, and it finally came right in January, just a couple days ago. And so, we were talking about the year-end rally, the potential for that, and how there was a change in character. And I think this kind of shows you the change in character. And so on a long-term basis, this persistent overbought nature we think is positive. But knowing that we were at risk for that pullback, and that we finally did see, again, just this at the very start of the year. So I wanted to keep this in. This is what we think is signal to us the change in character, just how overbought we continued to be with that, and while making new highs as well. Okay, and I'll talk CPI again. This is a hot topic. We're gonna get that report, I think, Thursday, and so just wanted to point out, this is I always like to look at the Fed nowcast. I think they're probably the best source of any forecast for these things, for GDP and for CPI. And I just wanted to point out, I would expect to see acceleration. Because that's what they're forecasting. I don't know if that spooks the markets or not, but it's something for you to be aware of. Because then you'll notice also, it's just a comparison effect, I think, going on in December. Whereas January, we're going to see that downward trend resume in inflation. So I just want people to be aware of that. If there's any spook or something that that's just 1 month. I think clearly the trend is still continuing to be down. And actually, I don't have the PCE number in here, but their forecast for the PCE has us going to something like 2.4% in January. And we know that's their preferred measure. And you think about that, if you see a 2.4% in January on PCE, that I think you can basically, you can say it's over, right? The inflation story has been squashed. And so I think we've been talking about that a little bit too, but just be aware, you might see an uptick in 2 days, but I don't think that's not going to be enough to change the path of the Fed. And speaking of the path, here we have just what Roy mentioned earlier, the Fed funds cuts. You can see what the market's pricing in for cuts, and that's about 6 cuts by the end of the year. And I can't remember, the Fed did put out numbers too in their last meeting. They updated their forecast for where they thought. I think they said 3 cuts this year. But for now, I think the market's it's either saying they're wrong, they're going to need more, or they're kind of trying to steer the Fed in a certain direction also. I mean, I think that obviously they're aware of this, but regardless, we're looking at a more accommodative Fed. They don't need to be restrictive with inflation in the 2s. And you can see interest rates a little bit, not long term, but a little bit further out in the curve. This is what you're seeing in the 1 year and the 2 year. This is basically pricing in the cuts too, right? You can see the peak in the 1 year at 5.5, the peak in the 2 year at 5.25. And that's, certainly you see that's what sparked the pretty sharp rally from November 1st. Okay, and here's a look at the 10-year. We'll still look at that, the long term, the long end of the curve. Getting this bounce, but this is a pretty convincing peak in rates, we think, and as long as we're not making new highs, that becomes a thing that's not in focus for us anymore. So just taking a look at the indexes, we got the Qs, and this breakout. We have 3 follow-through days where I think we bought each of them to some degree. And finally, that third follow-through day that works just when the indexes are breaking the 200-day, the 50-day, and it looks like everything's ugly as ever. But there you go. The third follow-through day worked, and we've gotten progressively long with that. Okay, and this is why we're more encouraged. We're not paying attention to the indexes, but we think that this environment could get easier. The indexes might be making new highs within a month or two, and then we think that's when the easy dollar environment really starts. And I think that you're going to see the Russell outperform, right? And so you can see this is a MACD, the momentum indicator, showing that it's just now turning up on a monthly basis for small caps. So, if that's the case, clearly, when that happens, you have a multi-year period of, strong performance in small caps. And so that's where we're looking, of course, for good returns, outsized returns. Um, and we're going to show a similar story with the FFTY. This is, what we use to gauge how the style is performing, how CAN SLIM stocks were performing. And again, you just see, the despair you could have been feeling, right? You're just fed up at the end of October, and out of nowhere, the Fed sort of pivots, right, and things start working. And so you did get kind of a scary break in that with the pullback, and that's what you're dealing with volatile stocks um, in this style. But you know, snap back, reclaim all the averages, and it's quickly repaired itself. It appears on a daily chart, and then weekly, we're going to provide some more context here, where this thing is down from 50 to 20. That's a 60% drawdown in the FFTY, which is the deepest drawdown they've seen ever. And so, we're encouraged, right? The index has needed a break, I think, to start, with after 9 straight weeks being up, and we think that this is a lot of opportunity to grow here. And if this index is up 50%, let's say to 36, then a number of these stocks that we're going to highlight are going to be up more than 50%. And here's the FFTY on a monthly basis. It's really the same picture that I'm trying to show as small caps, right? With this monthly MACD indicator in the bottom turning positive, and really has yet to get going. You kind of got a head fake in July, which people at this meeting I'm sure experienced the head fake. But here we are again, just now turning positive, and we think that sets the stage after a brutal, decline. And
Yes.
here's yeah.
Yeah, I'm reminded of the old adage. Back up one slide, if you will.
This
I'm
one?
re, yeah, this one. I'm reminded of the old adage. Uh, the second mouse gets the cheese. We thought we had the first mouse there. We were the first mouse there was in July. He got squashed. And we think it's real this time. So the second mouse is really going to get the cheese here, we think. So
Yep. Yep. Hopefully. So anyways, here's more on the style. Here's the IBD Mutual Fund Index. It's the top growth managers. And it's just the same story. It's just growth not really being in favor for a period of time. And so hopefully this turns, and these guys have a really good track record actually about performing on a 10-year, 20-year basis. And so I'm sure it's been a frustrating period of time for them as well. Okay, now here's the NASDAQ and the MACD, the momentum indicator. And so we're bouncing, and the momentum is waning, as you would expect from an overbought level. The bounce was welcome and timely. We think kind of on schedule, if you will. And so, it's working through this overbought level beautifully while momentum wanes. That's totally fine, right? The market needs a rest. And we think, a lot of these other stocks have acted a lot better than even the indexes now we're noticing. Okay, and so here's the NASDAQ in moving averages. So, this is our measure of trend, and the green line is the 10-day, and here's the 21-day in pink, the yellow 50-day, and the red 200-day. And so all of these moving averages are in agreement, right? So the shorter term ones are above the longer term ones. And so that would, be indicative of, basically the trend being up on all measures based on the moving averages. And Roy talked about this last week or last month, and you can take a look back at that presentation too, about the power trend, right? And so, on that measure, we're certainly still in that power trend. And, that really just has to do with the moving averages all kind of aligning like this. So, that's good, right? It should be easier if everything is signaling an uptrend. And okay, here's the NASDAQ and the 30-week moving average. We mentioned, I think,
Wes,
earlier
let me
too,
point
that,
out one thing as well. Back up one slide.
yeah, going back.
Uh, historically speaking, when you're in a power trend and you go 5 days below the 21-day EMA, and that's the magenta line, that it becomes dicey. So you don't want more than 5 days below the 21-day. And you can see in this case, we were 3 days below the 21-day and we powered back above it. So what that's telling us is that there's true power in the market. Just like today, the market opened down in the NASDAQ significantly. We were down triple digit numbers and we closed up on the day. In a new persistent new bull trend, you want to see a weak opening followed by buying throughout the day. And that's what the current situation looks like to us. So that's quite positive.
Yep. And so here's the 30-week moving average and the indexes. We would consider this, you want to stay above the 30-week moving average to be in a long-term uptrend. And so again, this October period where we actually got two closes, which to us would say, we're entering a long-term downtrend again. And then just in time, the Fed, I guess, comes in, becomes a little bit more dovish, and a follow-through day happens, and you get this really quick snapback rally of 9 straight up weeks. So, to us, this is just we're back you can't argue with it. We're back in a long-term uptrend based on this. Okay, and here's a look at the S&P and the percentage of stocks above the 50-day right here. So that number is at about 87%. When we got up here to 80, whatever, 5%, that's when everyone was sounding the alarm too, and continues to kind of maybe think we're overbought and still can rest, right? Just want to go sideways is really what we need to do. So we want the index is basically what will happen is the stocks can go sideways, the 50-day moving averages can catch up to some of the stocks that have moved up. And so then you get this number come down to some extent too, because those 50, it's a combination of stocks coming down, 50 days moving up, and you again work through that overbought kind of level of stocks above the 50-day.
And what may occur
Okay.
as well is the indexes can go sideways or really just come in slightly, but you're going to see a divergence between the leading stocks that hold up. So it's important to screen for the stocks with the top relative strength, those that have the highest relative strength, and those stocks where the relative strength line is making new highs. That's where you want to be. That's your buy list today.
Mhm. Excellent. So this chart's looking at the stocks above their 200-day, and this is at 77% of stocks above their 200-day. And so to me, this is saying it's still not, we're not quite at that part where it's a rip roaring bull market, but you get to a point like in 2020 where that number comes up just a little bit more, and you can stay there for a long period of time, where you've got 80-90% of stocks in an uptrend, I guess, based on the 200-day level. And we'll go look at the NASDAQ now. It's the same indicator. So the stocks above their 50-day, not quite as high as the S&P, so it's playing catch up a little bit. Right, and then this has some room to peak higher too. It peaked at 90% back in June of 2020 as an example. And like Roy was talking about, that's where you see, okay, there's divergence, right? You see that a number of these stocks fall below their 50-day, but the leaders are what propel this thing forward for a number of months again. So anyways, I think this is just I think, this is encouraging for us just to see the participation again. And we do think it's different. We think that it's different this time compared to, all these other rallies. And then here's the stocks above their 200-day. The Nasdaq sitting at 49% of stocks above the 200-day. Again, if the trend's really getting going, it's been 2 months. There's a lot of room to go, we think. And here's the stocks making new 52-week highs in the Nasdaq. So here's the gross number of stocks making new 52-week highs and 52-week lows in red. And then below here, this is the net number. So blue meaning that we're getting more net new highs. And so, that didn't even turn until December, where we're getting new highs. And so this should tell you too that we're just now entering it. So even in November 1st, when we know that we were getting that signal with the follow through day, you were not getting exactly broad participation, but we're starting to see that, we think. And something that we saw that was encouraging, wanted to point out too, in that first pullback, that initial pullback in January, is just the kind of lack of growth in net new lows. So, that's telling you that the market's healthier on this pullback, right? That's dramatically different from what you were seeing in October, with that big explosion of new lows, with those pullbacks. Okay, and here's a look at 5-year chart. Same thing. Again, we think the beginning of this. Here's the New York Stock Exchange. So, a little bit of a different type of stock in here, but regardless, telling us the same thing. Looking for that, more participation, new 52-week highs picking up, and further back, looking at this thing. And here's, what a bull market looks like. It's a year and a half, 2 years. We'll see how long this one can last, but it's stocks making new highs repeatedly for several months.
And by the way, just for the record, we do think that we're on the cusp of having a 9-month to 2-year bull market here.
Okay, and here's the McClellan oscillator again, something we checked on earlier in the presentation. So, but just again for your reference, again that overbought, and then the pullback nearly oversold, but not quite to that level that we consider oversold. But a good rest, a good healthy rest. And here's the VIX, and the VIX below 20 has been very welcome. It's a much better environment for stocks, and you see the collapse, where there was clearly a lot of worry in October. You wonder if this thing's going to spike to 30. It didn't. It completely collapsed, and now we're in this environment where it looks, trading has gotten easier for 2 months. This is a good indicator. This is a survey of saying how long active managers are in the bottom. It's the National Association of Active Investment Managers. And so based on their survey, this should have been a good clue. Everyone was talking about the overbought near-term market, and this would have told you again that, hey, 100% people are 100% long based on this survey, similar to July, and we did get a pullback in July, right? Quite a nasty one starting at the end of July. And so far, what's been nice about this is that, the active managers were quick, I guess, to lower exposure. So coming into 71% maybe repairs a lot of the action. Okay, here's the bull versus the bears. We can see the bulls are getting, relatively high. I don't know. I don't have much to add here. It's just, we can continue to watch this and see if it ever gets extremely optimistic. I mean, you might say that this is, but it's hard to believe that just with the way stocks are acting, that this is going to be an issue for now. And here's a look at the long-term net view of that number, right? So if it's blue, you have more bulls than bears. If it's red, you have more bears than bulls. It's been persistently red for some time, and it takes bulls to make a bull market. So we're just, I guess we're not really trying to time anything based on this indicators at this point. But you'll notice in the 90s, right? It's a persistently bullish environment, not to mention the thousands. So anyways, take this with a grain of salt. I think another good, bull/bear indicator would be this put call ratio. And again, this is similar. I don't have much to add on here other than, we're not in a complacent state. We're not in a panic state. It's pretty normal. And so, we've got room to go lower. We could spike again, sure, who knows why, but in a bull market, I think we see this, go lower and kind of stay consistently at a new average. You'll notice in 2020 and 2021 that the average was really this red line for a couple of years. Okay, and here's the equity put call ratio, just another measure, extremely, extremely volatile. And I guess this could have to do with those 0 day to expiration options, perhaps, and it's just throwing a complete wrench into this indicator with how many of those are traded now. Okay, and here's the high yield spreads. This is a measure of credit risk, and we've seen that consistently come down again from November. So, whatever the Fed signaled, certainly helping the bond market as well in this. Okay, and I figured I'd take a look at ARK again. Maybe we'll take a closer look at them with, if we're gonna get in a good, strong bull market, these guys should probably perform well. But you saw it get overbought too, just like the general market, and now coming in kind of hard. But on a longer term basis, you could say, you could see the similarities to FFTY, right? Or IWM, just the magnitude of the drawdown just a little bit bigger, but still possibly turning here. And we know a large holding of hers being Coinbase and levered to Bitcoin. And so Bitcoin, I'm sure, could be a popular topic on this meetup later on, but there's nothing really telling you to get out of this. It might be the most anticipated sell the news event ever, but who knows, right? For now, we'll just have to let the action dictate how you handle it. But nothing really wrong with it. An interesting shakeout. I forget what happened that day, but I know that it probably hit 40,000 overnight, when nobody can even trade it. So, or no, you can't trade it with a GBTC or what probably most of us are using. Okay, a couple more here. This is crude. We talked about this the last few months as well, and just talking about how the collapse in crude is definitely good for Fed policy. It's good for inflation. The argument against that is, okay, it's signaling a decline in demand. Well, for now, the stocks certainly don't care that it could signal demand destruction. It could just, for now, stocks care that inflation's cooling, rates are coming down, and the Fed is going to have to become accommodative. And the U.S. dollar, not a lot to say here, I don't think, but it was an issue with rising rates and the rising U.S. dollar. Right now, it looks range bound. It doesn't look like we're in an uptrend by any means, which that's helpful for stocks as long as we're not in an uptrend in the dollar. That seems to be a better environment for stocks. And then lastly, I'll bring up gold again. I think we haven't looked at it the last couple times. If I had to guess, we took it out of the slides right around here when it had collapsed and said, all right, forget it. But wanted to get it back on our radar because I don't want to forget about it. Although I don't think I have a good record personally with gold, and making money. Um, but here's the daily chart. It's kind of resumed this uptrend with the decline in interest rates, and it's really knocking on all-time highs. So that 193.18, I believe, was an all-time high. And it's just been a widely watched massive base, right? So it hasn't made a new high for 12 years. And so this is what we call the Brobdingnagian base, coined by our good friend John Roque at, where is he, V22 Research, I think is what it's called. So yeah, this is the last slide. Just want to highlight this again because I don't want to miss it either. So if it really is a big deal that it's doing this and it's trying to break out, keep an eye on it. Right? If it goes to 195 on heavy volume, I think it's going to be something people should be aware of. Right? And that is it.
Okay, any questions so far from the audience? Anyone want to throw out their 2 cents?
Yeah, I have something for you, Roy.
Sure, go ahead.
So every TA person that I follow is definitely super bullish, and the one person that I respect that is super bearish, I'm sure you've seen his stuff, is Peru on Twitter. Do you have any comment on the stuff he has to say? The bear from the bear's point of view?
One moment, let me just get where I am here. Okay, let me get rid of that. Okay,
What was the name you said again?
It's Peru Santana. I know we've talked about him here before.
Yeah, that's what makes a market, Jonathan, I guess. There's gonna be, bulls and bears, and the macro environment, according to, for example, Keith McCullough, has been extremely negative, but that's nevertheless the indexes, in fact, have been in this uptrend. So I try not to get too enamored with the news, the noise, information, the backdrop, and so forth. Really, it boils down to identifying the individual stocks and find those stocks that are powering ahead. And we're seeing a proliferation of those now. So despite the potential recession that's on the horizon, it may or may not occur. The West just showed you the spread between interest rates, and those aren't demonstrating any economic jeopardy that's at the forefront. So we're unequivocally bullish based on just because of the trend. When the trend changes, we'll change our tune, but we're definitely in an uptrend. And of course, the old saying, don't fight the trend. So the trend is in an uptrend, and we're fully invested. And we'll continue to be fully invested and just weed and feed the ones that are underperforming and give more money to those that are performing in this current market environment. And that's what we would do. So, if this market environment turns out the way that we think it will be in terms of growth coming into favor and a move to small cap and mid cap stocks, those stocks that have been out of favor for quite some time, we think it's going to be a powerful move, like in the Russell 2000. We think that's going to be the place to be in 2024. So, I guess you could also be bearish on different segments in the market and bullish in other segments. But we're seeing a wide range of industry groups that are participating. So we're certainly bullish right now.
And I don't pay attention to this guy that much, and I probably follow him or I see tweets of him, but his pinned tweet as of December 22nd, you know, December 22nd is talking about leading growth stocks, and a number of these are things we own or kind of wish we owned if we didn't buy them. Right. So like Celsius Crowd, Duolingo, Melly, NVIDIA, Zscaler. So while he's, you know, if he if he was bull or bearish, I don't know if he is that bearish anymore. Right, just this, and this is the way we're thinking about it too. If stocks ignore the weakening fundamentals, have shallow pullbacks in Q1 and trend higher, it will imply that perhaps the stock market is front running the Fed easing and looking past the downturn. And so, same with our guy Keith McCullough, who keeps talking about January and February, recession. Like, I don't see why we should care about 2 months of recession. Um, like let's talk about what's going on beyond that, right? We don't care about what happens in 2 weeks. We care about what happens in 12 months, right? That's what the way markets should work is they typically try to, find the longer term trend in that. And maybe we're right or wrong, but that's the way stocks are acting. It's not telling us that we should worry about the recession.
Hey, this is for us. I just have one other question. Looking at the weekly for IWO or IWM, if you go across the RS rating, it kind of looks like it's gonna keep on setting up higher, higher lows.
Take a break.
Yeah. Do you guys see my screen? Do you see the IWO on the screen right now?
No.
Okay, I'm trying to share. Hold on, give me one moment. How about now?
Yes.
Okay. So yeah. For us, go ahead. You wanted to take a look at the IWO.
Yeah, I was just looking at the RS rating over time, and as you see, last time it set the stock set up, IWO set up a newer high. The RS rating was still setting up a higher low, or not a higher low, but a lower high. So I just want to see what you guys thought about that. I'm still bullish as well, but I'm kind of keeping this in the back of my mind as to, is this a sign or something to ignore?
Yeah, well, I'm looking at the IWO on the chart right here, and I'm looking at the relative strength line, which really plummeted down there in November and actually made a new low right there in November. And to me, it appears as if we're just having a normal little pullback here in the last couple of weeks here. Now, what's interesting is that we normally don't buy things that are out of favor, but we do own the IWM, and we normally don't own stocks that have a relative strength of 65. You see the relative strength of 65, but when you have a particular group that's quite distressed and it's been in a bear market for multi months, that's typically how it starts. When from a low relative strength ranking, we would never buy a stock that's got a 65 relative strength. Most of the stocks that we're buying are in the 90s typically, but the indexes it's a different animal. And it's interesting when you look at I would suggest, as I'm sure that you look at as well, look at all these indexes and individual stocks on a daily, weekly, and a monthly basis. And I was noting the other day that how a couple of stocks, maybe even Celsius, looked quite volatile on a daily basis. Or actually, when you go back and you look at when the video went through its pullback, it looked, kind of jagged on the daily basis. But then when you looked at it on the weekly and monthly, it just basically looked normal. So this is really what we're looking at on the IWO. You can see it's got support. It's down to 2017 area, 2017. There's the support. So we think that support is significant. And you're basically guessing for us, in this sector, in this group, but we just see a culmination of the work that we're doing. It's leading us to this group, and the group in small and mid cap. So you can see you've had 2 months that are big off the bottom, and you're consolidating right here. Now, what will lead this trend? What will confirm the trend, in my view, is when you take out that monthly high in December right there, you take out that high, and that would be a time to, I think, get more aggressive. And we're in the IWM, which is the broad measure there, and we're in it, and they basically look very, very similar. And so we're looking at that IWM too. In fact, on a technical basis, just as from a measured approach, that IWM that hit that roughly 230 area, got down to 170. So that suggests that this should have a target of around 300, in the next year or so. So that's from a measured approach. That's where we see the IWM going after not doing anything like the IWO for years. I mean, so it certainly makes sense. And this is just anecdotal as well. When you look at an index that hasn't done anything in 6 years, but look at the moves that it's taken place after the 2008 bottom. I mean, you've had staggering moves of 100% moves. And if, after this congestion for almost 3 years, we think the time is right for a multi-year move, just like we've had in the past when you look at this over the last 25 years.
Yeah, just to clarify, I was just trying to talk about the February RS rating versus July versus most recently.
And are we talking about the daily or weekly? What do you point out to make sure I'm seeing it correctly? On the
So if
RS,
you go to the weekly,
okay.
yeah, the weekly, if you look at the RS rating between February versus July versus most recently in late December.
No, the rating is the rating is 65. I don't have what the ratings are before that changes. Now,
yeah, so just a line,
okay.
If you just kind of draw a line from February to, like, if you just compare the levels.
From what period? From what period?
If you go, on the weekly, you just kind of go compare something like February of 23 versus
February of 23, right?
Or March, whenever that high was, and then you compare it to. You can keep on seeing that the RS rating keeps on setting lower highs.
Oh yeah,
even though the market, the IWO is making slightly close to newer highs.
Exactly.
So I just kind of noticed that, and I don't know if that's anything of concern or is that something.
It's still basically in the toilet. It's still early. Even though the indexes have rallied right here, really what you would like to see is you'd like to see this go sideways and then take out this prior high in relative strength. If you when you take this high out in the relative strength line right there, going back a few weeks ago, I think then you're going to be in you will be able to observe a more persistent uptrend. So it's just show you there's the bottom, here's the consolidation, and we think the next move is up. But you can see also support there on the weekly. There's the 10-week. So this market, there's no question this market could, in small caps, pull back to the 10-week, but it's trying to turn right here as well. So it's a very subtle turn on the weekly, in the Russell right here. Now, I think you'll also see this upturn be more persistent when you take out this high of 3 weeks ago. See right there in the Russell, and it will be obvious then that we're in a new uptrend. That you can see where the pivot points are right there at 260. That's going to move to a 20% profit over 300 on the run. We think that's we think it's quite possible that's going to happen by the end of this quarter or the early of next quarter. It's an art.
Right, thank you very much, Roy.
It's definitely an art. There's no science behind it. It's just what a practice eye sees after trying to observe the nuances.
Roy, I have a question. but we're looking at the NASDAQ composite, we're looking at the slides, and you mentioned that we don't want to see more than 5 days being under the 21-day moving average. And we just had 3 days there, right? So
Yes.
I was wondering if you're talking about on a closes basis or intraday basis, just
Closing
go down there
basis.
and right back up. Is that
I mean,
based on the
that-
market school,
that's
I guess,
closing.
rules?
Closing basis, and that's just something that IBD, that market school teaches. That's one of the nuances there that they've taught over the years. It's sort of like an early warning. It's an early warning signal, just like, you know, a lot of times we're short-term oriented. We found that if you have that typically stocks bottom like 2 days below their 21-day EMA, stocks, very strong stocks that are in uptrends, typically don't come in more than a couple of days below the 21-day before they turn. And so that's just one of those nuances as well. But, you know, this is interesting when you look at the NASDAQ from a weekly, this is on the weekly chart. On the weekly chart, this looks quite constructive, but we're still down significantly from the top there. But you can see where we hit the 10-week. And most of you that follow Wes and I on Twitter, you would have noted that we mentioned that we sold into this move up. We started taking money off the table and just building our cash position, and with the thought that we might come down to the 10-week, and we got right there at the 10-week, and then we bounced. So this is really textbook. This is classic, what you want to see. That sell-off was quite dicey, but it didn't stay there long. So what that's suggesting is that many institutions are coming into the market here and supporting the market, and that bodes well for the future. So we do recommend highly MarketSmith. This is just a great program for getting information for visually. So taking a look at the indexes and also screening stocks and the information that it provides on individual stocks that we'll talk about in the second part of the program. But you can see we're in this quote power trend right now. And so you should lean bullish really until this 21-day closes below the 50-day, or we have some type of vertical fast break of the 50-day on volume, something out of the ordinary that comes where you go straight down on big volume. And that would suggest a more cautious approach to the market. But right now, this was just a short-term pullback. It was, these 1, 2, 3, 4, 5 straight days. And I actually posted something on Twitter. That's only happened 5 straight down days on the NASDAQ. It's only happened, the last time it happened was 308 days ago. And if we had 6 straight down days, that's only happened, the last time that happened was 800 days ago. That's 3.5 trading years. And if we had 7 down days, that's only happened in 7.5 years ago. So this pullback, presumably because we had this melt up towards the end of the year where people did not do any selling because of tax. They wanted to wait to sell their gains until the beginning of the next year. And we think that fueled that, that last couple of weeks in December, where typically you would have tax loss selling then. That was, we didn't have any of that this particular year. But so far, so good. You had this little pullback. And incidentally, when we look, you had this little pullback, but now you see the leading stocks like CrowdStrike and NVIDIA power ahead. So that's exactly what you want to see coming out of this mini correction.
I have a question or two.
Yeah, go ahead, George.
Hi, this is George from LA. 2 questions. Number one, do you trust the numbers that come out of Washington, specifically the employment numbers? And number 2, do you feel be better for us, better for the markets if we get a Republican or a Democrat in office in November?
Wes, go ahead and answer that, Wes.
Um,
No brainer.
yeah, I trust the numbers. Basically, I mean, I don't think I really have a reason to not. And you can't, I mean, you just can't lie that much here, I don't think. And there's too many other sources of information that people can use too, like alternative data sources, um, that I think you can trust our numbers here. And so, yeah, that's the short answer, I guess. And then, so I was trying to pull up my almanac because I was looking at this earlier today and was thinking about putting some January stats in. But they certainly they do have presidential election stuff in here. And there's this, you know what? I don't know if I can just show this, but they have the numbers. God, I can just resend this whole chart. I feel like I have this from last year too, potentially. Basically, I don't think it really matters. I think historically Democrats in office, um, it's way too small, I would think, unless you zoomed in on my, thing, but there's just not enough of a look. Okay, Democratic presidents, the S&P or the Dow Jones goes up 10.4%. Republicans, it goes up 7.4%, on average. So technically, Democrats are better, right? Which you would think they aren't because they're not like, business friendly, I guess, right? And the best combination is a Democratic president with a Republican Congress. And, you'll notice that's what we have now. But anyways, I don't think we really care. We're not going to make a decision based on that, anyways. But I can send this out. Maybe I'll add this to I'll just add this to the slide deck that we send out.
And actually, in the percentages, and I happen to know this as well. It's the numbers are very, very close. Like 52% of the time, like maybe Democrats are better. 48% of the time, Republicans are better, and that's going back since from I think maybe 1933 or 45 or something like that. So there's a very small difference from a political party that would dictate, who's going to be, if the market's going to go up or down or not. It's what's much more crucial is what's going on with the economy and earnings on companies. George,
Thank you.
you're welcome. Any other questions about the market, guys?
Hey, Roy.
Yes.
Excellent.
Just wanted to
I've
say, I
got the
don't
chart right here already from November of 2022 when our meetup then.
Wes, are you saying something?
Oh, can you not hear? Can you hear me?
Yes.
Oh, yeah, I was just gonna say, I have the slide. I was able to find the slide from the November 2022 meetup group where we looked at the political alignment and market performance. So I'm just gonna drag that over to our current one.
You want me to stop sharing right now? Wes? 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 I don't think he's hearing me. Guys, look, let's go ahead and take a 5-minute break here. Let's take a 5-minute break and then we'll come back and we'll talk about individual stocks, what everybody's waiting for. So we'll take a 5-minute break, get back on the computer at 8:25 sharp. See you then.
Hey, Roy, I just wanted to say that I really appreciate what you and Wes do. Your presentations are always great.
Thank you so much. We really appreciate that. We love doing it. We love the preparation, the work, and we're delighted that we're delighted to have you here. And we hope that we can add to your investment process. Thanks. It's very kind.
Roy, this is Alex.
Hey, Alex, how are you?
Good, good. Thank you for a very good presentation. Have a quick question, general question about economy regarding the U.S. debt. You know, it just keeps on going exponentially up, up, and up. So, I mean, U.S. economy is in position to service it, but, you know, will it eventually reflect on the growth and, you know, the whole economy overall?
Boy, doesn't that sound like the black swan event of all time? It does to me.
Yeah.
And but you know, when I began in the business 30 years ago, Alex, it was the same. We had the same questions that were prevalent at that particular time. And you know, all I can say is that all of that will be reflected in the market and in the trend of the market. And when the trend changes, you'll be adequately prepared, you know, to reduce exposure and go to cash, you know, and avoid one of those bear markets like from 2000 to 2002 and 2007 to 2009. But that's the kind of thing that makes my hair, the hair that I have, it makes my hair curl, because we know fiscal irresponsibility is not good for running a business, running an economy, running a country. So, I mean, you're making the very best point that I can make as well, in terms of, man, that's got to be dangerous at some point down the line. It's just not impactful now, but it's got to be a potential black swan event in the future.
Right, something to be aware of at this point.
Yes, sure.
Thank you.
You're welcome.
Roy, I also want to thank you for these presentations. They're amazing. And you mentioned that you guys are you're gonna have Trader Lion or Richard or someone else there helping you on that as well.
Yeah, we talked to Rye, this weekend, in fact, and what they're going to do is they're going to host this meetup, and they're going to put it on their channel because you know, because it's been useful for many people, and it will broaden their audience as well. So we'll happily provide this to them, and we'll just put a Trader Lion logo on it, and we're happy to endorse anything that Trader Lion, any of their products, any of their research. We think they're the best. You know, we happily endorse those guys. They're really good.
Oh yeah, they have a great follow, and that Ultimate Trading Guide that they had recently, the 9 series, whatever, some Saturday series, that's great, really fantastic.
Yep. It's a good team. They're very young too. You know, all those guys are, Ross Haber's 50, and he used to work for O'Neill. He was a portfolio for O'Neill. The rest of the guys are, I mean, Rye is 31. I think Richard's 27. Nick's maybe 27. You know, young guys. They'll be around for decades.
Yeah, they're really good. They're really good. While I have you, I wanted to ask you something real quick. Do you guys happen to have a trader tax status with the Election 475, where you guys don't have those wash sales in trading accounts, taxable accounts?
I do personally, but we don't.
You do? Okay.
I'm not aware of any of our clients that do, because you have to meet specific requirements to be classified as a trader. And it's just not managing your investment portfolio, but there's big benefits from doing so if you're able to do that.
Yeah, I was looking at Robert Greene. I guess he has great advice on that.
Robert, that's interesting.
Robert Greene or something. Yeah. Do you actually not get any wash sales in your taxable account? You just, if you rebought shares that you had a slight loss on, you don't get any wash sale, just as if never happened?
Right.
That sounds fantastic, you know?
It is. But you also, I mean, we're not providing any tax advice or recommending anyone to do that.
From trading perspective, I guess.
But you have to also give it to the IRS a year ahead of time. You can't do it after
Yeah,
the
yeah.
year's been established. So you have to have your CPA send in the documentation before the next year to actually achieve that as well.
Exactly. Yeah.
And
No, because a
again,
lot of times,
and also remember, if if you do classify yourself that way and you're not approved by the IRS, there are going to be significant consequences. So
oh yeah.
the government wants to get their share.
Absolutely, yeah. But from a
Hello,
trading
Wes.
perspective, yeah.
That was
Sorry,
an important question. If you could repeat the answer. Sorry, I was on a break and that seemed very important.
We just talked about the tax status of traders, and you can Google that to avoid wash sales. The only way that you can do that is be approved and have tax trading status as a trader. And there's a lot of criteria actually that you have to go through to actually be exempt from those wash sales. And not very many CPAs know about this, know how to do it. It's very complicated. So you can Google that and probably find people a few selected people across the country that focus on that.
Thank you.
You're welcome. So guys, let's get started on individual stocks. So let me pull this over. And this is really we're going to get into, let me get everybody over here and share my screen. Move this. I almost ended the meeting just then, so hopefully I don't do that. Okay, and pull this over. And get it here. Okay, perfect. And then I'm going to share my screen. Screen 1. Okay, do you guys see my screen? And the NASDAQ should be supported on the screen. You do. Okay, let me get started, guys. So we want to try to find the new market leaders in the stock, and I'm just going to basically point out what we own in our portfolio, currently, and we think that we've got a combination of these that we think that are the leading stocks in the market today. They've all got great, robust fundamentals, and it's the technical aspect. Once you identify the stocks on a fundamental basis, then it becomes, it's all about timing. It's all about where do you put the positions on and so forth. And so, we'll take you through just a few of these in alphabetical order, just so you can see basically, some of the stocks that we think have great potential in 2024, moving forward. So the first is ARM Holding. And you can see ARM Holding, this was an IPO that, it's a chip company. NVDA actually owns a part of ARM. ARM was in the business many years ago. They went private and they came back in a public offering in September. And it's one of these IPOs that's in an advanced phase right now. It broke out of an IPO base. You can see the numbers were quite good last quarter with an earnings growth of 118% and revenue growth of 28%. It's a fairly accomplished company with a market cap of $73 billion. And you can see that this stock had this perfect cup and handle breakout right there at 65. We bought the stock at 65 for the first time, I think right there on that cup and handle breakout. And then we pressed the stock and added more at 69 as the stock moved a little bit higher. So what we're trying to do as a CanSlim investor is take your best stocks and average up. And what you would want to see is you would like to see this stock you can see I have this down trend line where you got these, where it actually closed very tight. You'd like to see the stock go sideways but find support here at the 70 area for a day or two, and then break this down trend line and be off to the races. So that's the type of setup. That's the perfect type of setup where you had a cup and handle breakout, follow through add, your initial positions not at danger, and you know, and the stock is setting up. CrowdStrike perhaps is one of the most important leaders in the market right now. We have a position in CrowdStrike. Unfortunately, we didn't press the stock yesterday, but we've owned this stock for some time. I think we're up 20 to 40%. I think we're up 41% from where we initially bought it. And you can see that you've got this stock in a nice uptrend with great earnings growth, 105% earnings growth, great revenue growth. By far, this is one of the leading stocks in the market. I'd say this is one of the top 10 leading stocks in the market. That's an institutional favorite. You got many institutions that own the stock. You can see you've got 2,000 mutual funds that own the stock, and it's populated by a lot of great IBD from stocks that are in the IBD mutual fund index, which is a powerful endorsement. You can see the stock just broke this downtrend line 2 days ago, and it just happened so quickly. And so you're seeing a stock that's where the relative strength ranking is 98, and the relative strength line is confirming new highs in price. And it really doesn't get any better than this from a leading stock. So you can see earnings growth is projected to be 92% in 2024 and up another 26% in 2025, which is a powerful endorsement of an industry leader. You can see it's in the number 5 ranked industry group out of 197. I'm getting some feedback. Out of 197 industries. So this is by testing. Hello?
Hey, Roy.
Yes.
Hey, Roy. Question for you. You know how today it made an all-time high, right? I think
yes.
Over that 261. Do you
yes.
think would it have been a risk to buy as it broke out over that on this stock? Like, do you think that would have been a risky trade?
Absolutely, it was a risk. I mean, this pullback is very short. It's not your typical VCP pattern that Mark Minervini talks about because it's not long enough. But basically what it's showing you is that the distribution and the digestion has been so short that it's not going sideways and letting you get in and establishing like a great pivot. These pivots are like really short. You know, this would be a pivot point, 261.80. It's prone to fail because it's so short. Yeah. It's like straight up. But yes, it would be risky. And typically we would have added to we should have added to this yesterday. We have this is one where we would try to have 10% in. I think our position is 5%. But when you get a breakout like that, it gave you a perfect illustration of a time to take it to 10%. So we're sitting here with the 5% position, wanting to get larger in the position. But this has got everything that you're looking for in terms of a market leader. The next position is DraftKings. DraftKings, what alerted us and got our attention on the stock was the volume explosion right there. And look what can happen. See, when you have these downtrend lines and you have a powerful move on volume, breaking a downtrend line, that's signifying tremendous buying pressure. And that stock on that day, yes, it had that 10-300 day that we like to look at. And we found that stocks that are up 10% in a day, at least 10% in a day minimum, and where volume is up over 300% higher than normal, that those typically can potentially be the next market leading stocks. And that's what got our position started on this stock. And we're considering adding a little bit more, but it is below the 50-day right now. So it's one of the weaker, but you know, technically what you're looking for is you'd like to see a break of this downtrend line back over the 50-day, which would be a buy signal. So technically, from a trading perspective, this stock consolidating right here, a break back above the 50-day would signify a buy. So you can watch this to see if the stock can break through. And then, of course, you want to watch the volume to see if volume is expanding and potentially providing a pocket pivot on the chart. So everyone's aware of how broad online sports gambling is becoming throughout, and how pervasive it is throughout our business. You have a couple of people like FanDuel and then ESPN that are competitors, but this is right there at the top in terms of the best in the business. So you'd want to watch this stock. Here's what got you in the volume right there. Now, what would provide an add-on point would be a break of this downtrend line on volume. But there's a good place to put a stop 4 days ago, and we will be out of that position if it takes out that low of 4 days ago. But we would add to it breaking the downtrend line. Duolingo is, of course, the digital language platform that's taking taking over in that particular field across the industry across America. You can see that the stock had a powerful breakout, and this breakout where it traded 3.4 million shares, the stock was up 21%, and the stock had 438% volume on the day that it broke out. And see, it's in new high territory. See, the stocks that are going to be the leading stocks, they're not going to be the stocks like, for example, a chart like Cathie Wood's and ARK. That's not going to be a leading fund, or in this, because the stocks in that fund they're all very near their lows, not 52-week highs. You want to CanSlim dictates that you want to focus your attention on stocks that are very clear to making or at 52-week highs or all-time highs. So you can see that this stock had a powerful move up, and then subsequently you had just a classic pullback to the 50-day. So the strongest stocks aren't going to go to the 50-day. Now, but many of true market leaders touch the 50-day a couple of times a year over the next 12 months. It's inevitable that they eventually will go there, just as the stock ebbs and flows and resets and corrects and stair steps, on its way to new highs in price. But so you can see the stock is found support at the 50-day, which is excellent. And this is why it's important to look at these stocks on a weekly and a monthly basis, as well as the daily. So many of you are aware of Eve Bobbitt, Kathy Donnelly, Eric Kroll, and the Life Cycle Trade. That's a great book, that really the best book that I've read on the market in the last 5 years. And they talk about this digestion phase that's called the turbulence zone, when these stocks, when IPOs consolidate and go through an institutional due diligence phase, and they finally go to the advanced phase, they reach this turbulence zone that's near the prior all-time high. So you can see that that's what's going on here. Is the stock was one of the first to break out. See, this is on the weekly. One of the first to break out. 1, 2, 3, 4, 5, 6, 7, 8, 9. So it broke out to new highs 10 weeks ago. Well, the market 10 weeks ago was looking horrible. But so it's one of the first stocks to break out to all-time high territory on the 10-week. You can see where it's trying to find support right here at the 10-week, which is important. So you'd like to see the stock hold. So, if it breaks this prior support, it's going to get a little bit dicey, but you have many A+ rated funds in this stock, and they do have a number of great financial snapshots. You can see earnings are far surpassing that 25% earnings growth and revenue growth. So earnings growth triple digits, over 100% the last 2 quarters. Institutions piling in. Some of these we think are the best mutual funds that you can participate in: T. Rowe Price, Fidelity Contra Fund, etc. So this is just a normal pullback. You'd want to see this stock rally off this 50-day, but it hasn't rallied it hasn't bounced the way that you would really want it to bounce here. So it just may need time to go sideways a little bit more, but it's got the chops. Elastic is the search company with a 97 relative strength. Notice the earnings growth over here in the left portal. Earnings are going to be up 351% in 2024. Notice the relative strength line breaking the new highs. Notice the relative strength rank of 97, so it's among an elite category. And notice the institutional buying that got us on board there. Volume's up 698%, and the stock was up 37% in a day. So in a good market, in a real robust bull market, it makes sense to buy these stocks on the gap, on the open, in many cases, and many times that's the low of the stock. This stock should be supported and shouldn't take out this opening low and fill the gap. You can see that on the pullback, volume has declined, which is what you would like, and it's finding support at above the 21-day EMA. And notice the earnings are up 900% last quarter, 260, 200, 200. So indeed a great fundamental story. His earnings are projected to be up 351% this year and 34% next year. And the stock is all over a new high territory. And it's got a little ways to go to get an all-time high territory, but it's in a 52-week high territory currently. Bitcoin, Grayscale, or the Grayscale Trust that's going to be converted to an ETF, is making its way back as Bitcoin has rallied. And take a look at that. Obviously you don't have any earnings here. You can see the stocks coming into this downtrend line that I've drawn here. It would be not unusual for the stock to consolidate, pull back here. Again, Wes mentioned this earlier. Indeed, this might be the biggest sell on the news event out there, but the fund flows, it makes so much sense that they're finally getting this regulated and launching it. And you've got 18 firms that have submitted an application for an ETF, and the SEC should approve this. This should come tomorrow. It should come tomorrow. Could be trading as early as Friday. The question is, well, what do you do with it? And we own this stock. We bought this stock at 29 right there. And we've got a 5% position in it. We want to get heavier, but we frankly don't know what to do ahead of this event. We think it goes higher and that you take out the all-time highs eventually, but you could have a pullback. You could have a pullback all the way to the 50-day. And this is one of those instances where it's just you're trying to follow the fund flows and trying to follow the volume. But you've got institutional support when you got these skyscrapers of blue. So that's suggesting that institutions are indeed coming in. And again, look, this thing just broke out at 20. We actually tried it here, were stopped out, tried it there, got stopped out. And the third time's the charm, and we did not buy it right there because we said, man, we've been stopped out twice, and that's the time that it worked. But we came on board, a few weeks later as it consolidated around 30 in the 29 area. And, with this breakout, this is an early stage. So these true market winners, they can go up to, we're not holding CrowdStrike or NVIDIA or Grayscale for that matter to make 20%. We're holding these stocks to make 2 or 3 times our money with the market environment is right. So it's definitely setting up. It's going to be all the news, the next couple of days. So get ready for it. That's coming. We do have a position in the IWM. We actually added a little bit on this inside day today for just a few people that did not have it, for new clients that came on board. We actually bought this right. I think we bought half of it there after the bottom on the pullback, and we pressed it there. We bought 5% there, another 5% there, and then we sold half of it into this rally, and we've got a 5% position. And this was mostly a placeholder, like the Qs for us. And now that we have, because we didn't right there, and at November 1st, we didn't know who the leading stocks were. So it's seemingly the best idea was, so let's just get some exposure buying the Qs, which we bought on the follow through day, and we bought the IWM soon afterwards, just to have some exposure. And then we'll end up, we can hold this or sell it depending on what our individual stocks look like. But we think again that this has got a 300 target this year. So, I think that gives you great growth, great exposure in small caps, both value and growth. If you're looking for a 20 to 25% return or more, in an index, we think this can provide it in 2024. Eli Lilly is, of course, known right now. Of course, this company's been around for ages. But what they have is they have the weight loss drugs, Mounjaro and Zepbound, and which probably will be the best-selling drug of all time. The best-selling drugs of all time. The inhibitors that's part of the biotechnology. It's really treated. It's used to treat diabetes, and just weight loss is a side effect application for it. But many people are using these drugs, and we'll get down to NVO as well. We bought NVO 2 or 3 days ago, but we have a position in Lilly that we've held, and you can see this stock's knocking on the door of all-time highs. Notice the breakout of the downtrend line. And from a trading perspective, this was my second largest position personally that I sold down here in this December area, because other stocks were moving and this stock was playing possum and in retrospect, but not moving. And then it just there was the day that it moved. Just the way really NVIDIA snuck up a few days ago, and just there's the first day. It broke the downtrend that alerted you to get in, and notice the pocket pivot that took place right there, counting back 10 days higher than any negative volume. That suggested there's the time to add the position. So this is obviously a major stock, a big stock with the $500 billion market cap. But, when you look at a stock like this, it's definitely a long-term winner, and it's going to be around, we think, as well as everyone else, for, forever. Melly is the Latin America Amazon, if you will, that's got great numbers. And it's one of these, and we actually tried this stock. Well, I'm just guessing that we tried the stock maybe in here and got stopped out. It had the fundamentals, and that's what happens. A lot of these stocks have pristine fundamentals, but they don't work, and they don't work. The purchase doesn't work because it's either the market, it could be the market, the pressure on the market, or it could be just the stock is wrong. But anyway, they got pristine fundamentals. Look at the earnings growth, 180%, 112%, 200%, 451%, with extremely strong revenue growth. So it meets all the criteria that would be in a model book for Ken Slim stocks, with that 25% minimum criteria for earnings growth. So it blows it away. And notice the difference between this stock and, say, Duolingo. See where this stock hit the 50-day and rebounded immediately off the 50-day. So there was a bid by institutions. See, that's telling you something right there. So institutions are buying it like right there at the 50-day. So you want to see that bounce off the 50-day. Now, what's going to get this stock going is now you can draw, say, a trend line. So now here, and we're in this position, but now if I can draw a trend line, there. So you'd like to see the stock consolidate here. That's what you'd like to see, it just consolidate here. It can either come, it can also come in, but just it's found support off the 50. And then a break of this downtrend line would be your early entry, if you're not in the position, or it would be an add-on position, add-on place to add if you're not in the position. Notice the A+ funds that are in the stock. See, that's what you want. So that's conviction. All the research that you need to know about all these companies, you don't need to have an analyst telling you to buy it. What you need is institutions that are indeed buying it and building the positions. So you have the best analysts on Wall Street that work for these companies, and that's going to provide the buying power and the impetus that you need to move these stocks forward. So great stock, 93 relative strength rank. You can see that this relative strength line has declined as we've gone through the correction. So you would look for this stock the relative strength line to improve if the market goes sideways here. And it would be a more justifiable reason to buy it if it goes sideways a few more days and then breaks out. Otherwise, it might give you that crowd type breakout where it happens so fast that you might miss it. So you actually have to have this on your radar. Many times when you have a situation like that, it's best to just have a buy stop at the market. And that way you're filled as these stocks go through pivots, because they indeed can happen very, very quickly. Okay, the next one, got a few more of these, and then I'll turn it over to you. Nutanix, a software company that is in that virtualization area. You've got 600 mutual funds that own it. Great numbers. You can see this is the earnings report, where this is what got our attention, that 10-300 that we often talk about. It was up 12% that day. Volume was up 497% higher than normal. And that's what got us interested. Notice where its leading stock made new highs, and yet it pulled back, see, to the 50-day right here. then resumed its uptrend. So you want to pay very close attention to these stocks like Duolingo, ESTC, and so forth to see if they get going just in a nascent manner at first that becomes more broader in scope as the stock moves higher. That's what you want to see over the subsequent days that are to follow. Last quarter, earnings were up 867%, up 247%. See, this is where these are the stocks typically, in my experience, these are the stocks that have the criteria that can go up manyfold, over the course of, many years, depending on the market environment, depending on how the company, executes. But this is you've got a stock in a nice, uptrend. There's the weekly, and also it's approaching all-time highs. Actually, Trader Line and Richard Moglen's talked about Dr. Wish, where he has something that he calls this a green line breakout, when stocks make an all-time high after the first all-time high after, and once they hit it, then you start looking at it from a monthly perspective. I think it has to be, it's got to be all-time high for a couple of months, or I'm butchering it. But
3
anyway,
months.
what's that?
3 months.
Okay, 3 months. Go ahead. Do you have that criteria, George, off the top of your head? What constitutes an all green line breakout? Do you remember exactly?
Basically, if he looks back 3 months, and when it breaks out, he'll buy and put the low. He'll put his stop right at the low, and if it closes back below, he gets out of it immediately. But if it goes back again above that green line, he'll buy right back into it.
And if you go back and you can actually, guys, it's Eric Wish. You can YouTube him. And I thought his work on his YouTube video was excellent. And what he shows a lot of these market winners like Cisco and Google and Microsoft stocks in the past that moved up for years, and they all began with those green line breakouts. So my thinking is that the real move takes place after the stock makes an all-time high. This is just a 8-year base. When this stock takes out its all-time high, that's when the move really starts. And we mentioned CrowdStrike earlier. Let me just show you what that looked like a number of years ago, where CrowdStrike, this is a green line breakout. See right here, where it went to all-time, this stock dropped from 100 to 30 in the 2020 bear market. So it got clobbered, it was down 60% or more in just a few months. But look how it snapped back. And when it made an all-time at 100, it went to 300 over the next year and a half. So when these stocks that have great fundamentals correct, and they finally turn around, and I think we're in that environment right now, like things like Dash. There are a number of these stocks that potentially are on the rebound, a number of these stocks that are on the rebound, that once they get to all-time high territory, then the fun starts. So we think that this is going to be really the beginning of the real bull market as the breadth expands later on in 2024. You're going to see a number of these, and these things are just going to be bid straight up. So that's what we're looking for. We think that indeed is going to happen in 2024. But that green line breakout's powerful. NVIDIA, which is my personal largest position, and I mentioned this on the Twitter feed, and everyone's aware of AI and how NVIDIA is in every application out there, from autonomous driving to gaming to Bitcoin mining to PCs, autonomous driving, etc. This is the leading stock in the market. And notice that this stock hasn't done anything for months. And notice this as well. See, notice when you had the green line breakout there, and this is just from a technical perspective. And I'm just pointing this out. Notice when you had the green line breakout here, after this stock went sideways, see, for 7 years, and then you got your green line breakout at 8, 10, then it went up 8-fold. See, in the next couple of years, the next 2.5 years, it went up 8-fold. And notice here, notice back in the 2000, after the 2018 consolidation, the stock it took 2 years, it went sideways, and then it broke out at 80 and went to 300. Notice here, we just got this green line breakout here. Perfect green line breakout, and also accompanied by volume. Accompanied by and corroborated by volume right there. And so that, notice it's been going, it hasn't done anything. It's been consolidating. And now you can see the breakout on the weekly, and this is picture perfect. And now, of course, obviously, this is the most expected breakout, anticipated breakout, of all time. But nevertheless, you had that a few years. You had that back in 2021 on Tesla as well. So you got a stock that's $1 trillion company that's got 593% earnings growth. This is staggering. 429%. I've never seen a company with earnings like this large, with this magnitude, as large as the company is. It's got an earnings per share rank of 99, a relative strength of 97. You can see where the relative strength lines go into new highs, and you had that breakout yesterday. And we had a 5% position, just to tell you how we handled it. And notice this as well, when you're going back studying the chart, because we've been shaking out of this stock too. It got dicey from 500 to 400, down 25%. It would have been tough to hold that stock there. Then you have this double bottom, see where it came in, rallied, and then you undercut that 409 area. So you undercut that, providing the classic double bottom, potential double bottom base, and then it reversed. And right here, you had institutions that came in. And so we had a 5% position that we moved to 7.5% on the turn day right there. And this is, if I can draw that right there on the first blue day, bouncing off the 50-day. And then we took this up yesterday to taking out in the 500s. We took it up to a 10% position. And it would not be inconceivable for this stock to be much, much higher. And, I had a question on Twitter about, well, what's your price target? There are no price targets. It's just when the stock, ends up, typically these stocks will go in and have a climactic phase at the last end of their run, and then they'll roll over. So you don't know that. You don't know how high that will be, nor do you know how long it will take for that procession to take place. But you've got perfect classical action. You really don't want to see the stock pull back to 500, the breakout, but many stocks that break out do come back to the breakout point So that in fact could occur, but you do have support now at the 10 days. See that 10-day, but what you would like to see, really, you'd like to see this stock go sideways, come in and go sideways a couple of days and then resume its uptrend. It will be interesting to see, but this again is my largest position. I have a significant piece of this.
Hey, Roy.
Yes.
Why is the accumulation distribution rating a D plus?
Hey, Amy, how are you?
Good. How are you?
Good. Yeah, the accumulation distribution, that's suggesting, and that's a proprietary measure by Investors Business Daily. And it really it consists of is the stock how many up days the stock is up versus down days. I don't know actually I'm thinking of the up down volume ratio. The accumulation distribution, it is a proprietary measure. I don't know how it is calculated, but it does suggest that while other stocks have made new highs, maybe perhaps that's why the stock has languished. That just explains, well, why hasn't the stock done anything, Amy, from this whole period of time? And so there's been, persistent selling. There's been more selling, versus buying until we'll see if that improves. If you see that you want to see this go to an A. And to me, what that suggests is that, okay, if it's D plus and it's at a new high, just think what happens if it goes to a C and a B and an A. And so it's not a yellow flag to me. It's anecdotal though. It's like that explains why the stock's held back.
Okay, I thought that meant like institutions or mutual funds and stuff like that. They were either purchasing the stock or they were getting out of it. And that's why when I saw that D plus, I'm like, well, given everything that you just said, you think people are going into it, but then are they dumping it?
Yeah, look at the volume the last 2 days.
Yeah.
And so, and again, look, you got 6,000, you got everybody in it. So you just wonder, and you have to ask yourself, is everybody in the party, everybody in the pool? But that's sort of what happened years ago in Tesla, like in 2021, and it worked. Like I actually put a piece out. I was thinking about this. Let me show you this. Let me show you Tesla real quick, and just take a look. And I'll put this piece out. Made this comment maybe in the last 30 days anyway. So let me show you this. So I'm thinking that, okay, based on the earnings, and I went back and looked at the powerful earnings that Tesla had just when they were launching their automobiles, because remember, they went from 0 automobile to some number. And so they had 100% growth forever, right? For a couple of years. But the real powerful story took place, once their earnings, when they got onto that S curve and earnings started to accelerate. Let me show you Tesla, TSLA. And now I'm a guy just trying to make sense of everything that he sees. By no means is this scientific, but I was wondering when I put this out, is this Tesla right now? Now, this is back in 2020. This is 2020. And Tesla had dropped. So Tesla was in that, we call this not inspirational phase. It's an accumulation phase where you don't have the earnings yet, but you have the hype on it. What's that called? How would I explain that? That's the not the glory phase, the hype phase, whatever. I forget. Romance. That's the romance phase from when the stock went from 70 to 190. The romance phase, they don't have the earnings yet, but the market is sniffing the new product launch. So you had this big move in the romance phase. So from the romance phase, then it got clobbered in the bear market. See, from 190 to 70, just got torched. You know, so the stock got crushed in the subsequent bear market. Then coming off the bear market, it doubled. And then, you know, it was sitting here going sideways for, several months. And then it broke and notice it, it also doubled from 70 to 170. So it was already up 100%. And then it went sideways, earnings came in and the stock took off. And so I'm wondering, the stock's already up. This stock was up 128%, and the power trend begins after this. And we recently had the power trend. Remember on the NASDAQ that I showed, and then this took place. So I'm just curious. And there's the top, of course, in Tesla, but we had this move, and this was accompanied by great earnings by the numbers. So I'm just wondering, we're in the power trend. And we're just going into new high territory. So as we look at this on the weekly and monthly, everything that we've looked at in past suggests to me, that this could be $1,000 stock. It could be a $2,000 stock. We don't know where the stock can go. But we don't need to know like what the upside is. We just need to monitor, well, how are the earnings doing and is the stock acting right? But I know you have a nice position here, and this thing looks terrific, Amy.
And Wes, for months, I usually write notes on the left-hand side in notes.
Yes.
About the AD and all a variety of different vital indicators. It has bobbed from C to E to F and it was just E. And now it has gone to D with 1.5. It was E with a 1.1.
Oh, no kidding. No kidding. Okay, so it was E. Okay.
Yes.
Okay.
I think in the last 13 weeks or so, that's what they do, IBD.
Yeah, I will. I'll have to. I'll have to research that. If you go to.
Hey, Wes, if you hit that chart legend and click on.
Yeah, where's the legend?
See down in the lower left?
Yeah, lower left. Yeah.
See where it says chart legend?
Yes.
Now click on the ACDC up here.
Awesome.
And it'll tell you, right? Click right up the top, right there. See? Over one more block. Up. And go up. Right there. And right down there.
Awesome.
Over 13 weeks.
Awesome.
But that's a lagging indicator, Wes, and the 1.5 is more important because that's
where did you get a 1.5 from? That's
the recent 3 weeks.
Yeah, you go to the weekly data and it gives you the up-down ratio. If you're on the weekly chart, see where it says weekly?
Yes.
Go to the right now where it says UD ratio.
Go up and down.
Where yield is, and go to the right and under the earnings.
Down.
And left. Down, to the left. See where it says
down.
Right there.
Yeah, click that.
The 50-day ratio. It's over the last 50 days. The number of up days versus down days.
Awesome.
So some of your leading ones are like in the 2s, 2.5, 2.3.
Yes.
I've seen some in the 3s.
Yeah, that anything over 1 supports a strong accumulation. And you're right, indeed. Some of these, a very, very strong stock typically has over 2, and occasionally, in advanced phase, I'll see them at 3s too. That's insane. So that's really telling you that there's tremendous momentum, in buying the stock. I mean, that's great. Thank you, guys. That's really useful.
Thank you.
Roy, what are your moving averages on the monthly? Is it 10 and 50 or something?
Yeah, if you pull up on the monthly, I have, and you can, what's nice on MarketSmith, that's the 10-month and the 40-month,
10 and
50-month,
40.
sorry, 50-month. So
Mhm.
it's the 10-month and the 50-month. And notice notice how that, and you can also look at this on the averages. And that's very, very useful. You know, the 40 week is on the weekly, you've got the 40 week and the 10 week. So the 10 week and the 40 week. And then of course on the daily, I have the 10-day EMA, the green line, the 21-day EMA, and then the 50-day simple and the 200-day simple. And people ask me occasionally, really quite often, why do you use, some people, very short-term traders use the 5-day quite commonly. Some people use the 10-day simple because it's not as quick, because it's 10 days, you divide by those numbers, versus the EMA, it's weighted. But I've enjoyed the 10-day and the 21-day EMA. I use that. I used to use the 28-day EMA for years, but I found that just looking at all the stocks and looking at how they acted, that the 21-day was better for my purposes.
Mhm. And on the
Okay.
monthly, you have estimates, right? The 10 and the 50 estimates.
Yes. Well, let me see. On the 10-month is going to be an 10-month is going to be an EMA, and the 40.
Oh, okay.
Let me see, because
If you tap on the wrench,
it's
and go to monthly, I think you're gonna see them there. Yeah.
okay. Monthly wrench.
There's a moving average.
Moving averages go down. Moving
Yeah.
averages.
Moving averages. Okay. So
There
this,
they are.
yep. So this is
10
what I
and
have.
50 exponential.
Yep. So I have the simple.
Nice.
Yep.
Yeah. Simple. Yeah. Thank you.
Yep. You're welcome. Okay, and we have, I've got a couple of thorns in the portfolio. So this is Path. Of course, they provide the bots, like the automatic bots to execute manual tasks and also automated tasks. But this is, it's basically AI too. But the stock is a turnaround situation. It's a Kathy Woods stock, of course. And the stock did power ahead on the earnings. So it had that 10-300 signature, and it's among the weaker stocks that we have. And it's right. We're right here about to cut. We've got a 5% position that we're going to take a small loss in, probably, because unless it holds this support right here. So it's broke the 21-day. It was holding up okay, but you got the pullback here. But if it goes to the 50-day, you're going to see it close the gap. So that's not going to be healthy. So, and it's one of these stocks that's lagging, but we played it as a turnaround position. They do have, the numbers are okay. The numbers are good. And you had the buying pressure on the earnings report. And so that should support and should have supported the stock greater. So you'll need to watch this stock. But if the stock breaks back above the 21-day, it's going to be game on. So really what you'd like to see this stock come in, maybe have an upgrade or something like that, and rally back up to this trend line, like something like this, and then go sideways and then resume its uptrend. And so ideally, this is really one of these stocks that might be sneaky. And I actually, I think I bought some of this yesterday on taking out the prior day's high. Personally, I actually bought some right there. And you want to see this stock get back above these averages and get back above this downtrend line. And if that, so, you know, if you see the stock move from here up, you can take a position, you know, whatever position, you know, you might take, and then going into to taking out this 2650 pivot, you would press it. So it wouldn't be inconceivable to get out of the position and then come back and buy it later, because it did have the signature volume breakout, and earnings are going to be up 200% to this year. And Pinterest looks great. You know, Pinterest, strong stock. Look at the breakout. See, look at, again, it just so happens that this is these are the perfect setups. There's the breakout on volume. There's the phase where it's just it's, you know, quiet, but it's advancing on you know, it's just it's the trend is advancing, but we call it earnings drift upward. So you know, the stock's moving up after the earnings, it's drifting upwards. And then you had your first little pullback here to the 21-day. See, notice here as well. See, remember, you know, I said like a lot of these leading stocks, they don't stay down more than 2 days or 3 days at the 2 days really below the 21-day. Notice it's closed right at the 21-day. And this is just, I'm just pointing out tactics here, that there's 1 day below the 21-day, the second day below the 21-day. And then, you know, so you can buy a number of these stocks, you can take a shot on these pullbacks and then use a stop right there, you know, the prior low, you know, once it turns up, once you have that up day, like right there, there's your stop. And that's where our stop is going to be, right there as well. But, you know, this stock hasn't come back. It did not go down to the 50. So it's telling you it's one of the stronger. So this is what you want to see with, you know, with great, you know, great earnings growth. You know, it's acting well. And this is really a turnaround situation when you look at it on the weekly, see the weekly and the monthly. So it's got a long way to go. But, you know, if it's, you know, Pinterest is an, you know, excellent company, and you can see where I actually have where the green line breakout. So this stock, before it gets good, this stock's can double. It's can be up 100% before it even gets good, before it gets going. And, you know, so I look, and obviously that's going to take, you know, that's going to take months for that to happen. But I'm always aware of where these stocks have been in the past and where they can go in the future. So keep that in mind. And Palantir, one of our weakest holdings, we've been in this, we'll probably get, there's the weekly. So it is holding support at the 10-week. So look, notice this doesn't look, this looks perfectly normal on the 10-week, coming into the 10-week, bouncing off the low, coming into the 10-week, and the party starts. There's going to be a party on here because this stock is well known and hated on Wall Street, and the party begins there when that takes place. And you know, the 10-week, it's at the 21-week, so it's a weaker stock. So this is the company that provides technology to the NSA, the FBI, and our intelligence services. But the stock is trending below the 50-day. And we actually, I think, pressed the stock right here, and we're down in the position. So we're giving it, we have high conviction. And so that's where we're holding. But there's our uncle point a couple of days ago. That's going to be by far that's our uncle point. But the numbers, this stock is well known, and it was profiled by Wedbush, Dan Ives, and you know, he thought that this was perhaps the most exciting AI firm in the marketplace today. And the stock did react better to the earnings, but look at what happened. They sold into it, so you had this bull trap, and you know, it's just consolidating, so it just needs more time. We mentioned the Qs, and we actually bought the Qs that day, and we ended up selling 5%, like right there, just to take some off the table. And now you can see it's acting, you know, the Qs are acting, you know, normally, and you know, they look good. This was a recent buy. We bought Shopify on the outside day to the upside right there. And as many of you know, there's the affiliation with Amazon Marketplace, where they receive their earnings and revenue. They have a relationship with a firm, pay as you go, as well, buy now, pay later. And this stock acted good after the earnings report. See right here, after the earnings report, and went sideways, broke this down trend line, see that I have drawn there. And we actually were in it and traded it once, but we took the position, we bought the position back right there on this outside day to the upside right there. And notice, terrific numbers here, you know, in terms of the last couple of quarters in earnings. And this would suggest, now if you own this, that you could press it right here. But you know, I'd like to see this stock go sideways a little and build out a right side a little bit. You know, if this stock would just come in for like a week, and by come in, I mean something like this, you know, just go sideways a little bit, and you know, the longer that it goes sideways, it makes a little shelf or base, the better the odds are that when it takes out 80 right here, that it's going to work. So you know, this is, you know, all these stocks that we have 5% positions, and our intention is to go to 10% as they all shake out over the next few weeks. You know, you're going to see who indeed are the true winners or not as earnings season approaches us. And I've got 3 more names, and I'll turn it over to you guys. Spotify, that has 400 upon last research report. It's got 473 million monthly users, a tremendous force in the market. And you know, this is a stock that's lost money. Look at this. See, this is the turnaround. This stock lost money for 1, 2, 3, 4, 5, 6, 7, 8 straight years. Now it's finally going to be profitable. And this is what is going to fuel the next move up. So you can see the stock had that volume signature that you want to see, where it's up on volume. That's institutional buying. And this is what I'm talking about. See how it came in today after having a nice day yesterday? And you know, with a chart that's consolidating like this, look at the 21-day too. See where it bounced off the 21-day? That's really what you want to see. Now that you can draw this downtrend line, now going through 200, see right there, that's where tactically you would add to the position right there. So you want to see this stock just sort of like find support here. You don't want it to take out, that's a no-no if it takes out that low right there, but it consolidate and then take out 200. We'll be adding to our position right there, you know, in an uptrend, being profitable, and, you know, a leading stock with a dominant franchise. So it's a turnaround, you know, it's a turnaround situation. And Uber, we're all aware of Uber and Lyft. Uber's the leader. And there's the breakout, you know, there's a breakout on volume, made a 52-week high. And we added to we added to this for new clients yesterday, right there on the turn, and we'll probably take this position up, taking out that high. You know, we'll press it, taking out that high, that pivot right there. So that's really, let me see if I can draw that. That's how I would handle it technically. You know, you got a nice 4 or 5 week base. And then when you take that out, it's going to be game on, hoop line on. So there's, you know, that's where you'd put your alert. So you'd like to see this stock just come up here, go sideways, and then give you time to buy the, you know, add it on the breakout. And finally, the last stock that we've got, the last stock is VRT, that provides cooling technology for these artificial intelligence server data centers, networks. And this is one of the, and we've talked about this stock ad nauseum for a long time, you know, for the last, got to be 6 months since these, you know, since they start, certainly from right here where it started setting up, you know, a few months ago. And it's just been acting normally. And it's one of these stocks that no one really knew about. Look at the revenue growth. Look at the revenues, 1.7 billion. So that's 3.5 billion, 4.5, 5. This is a stock with $6.5 billion in revenues that nobody knows about. So they're in that, you know, so they provide the build out. You know, they provide, you know, some of the build out in their products for data centers, and you have an excellent, you know, you have, you know, stocks in new high territory, and it's stocks viable right here in my view. You know, technically. So it's got great earnings growth. Look at the earnings growth, 600, 400, 300, 1,600. So that concludes this portion of the program. So that's just to give you an idea. That's not, look, and I'm sure I'm going to stay on here and we'll talk about stocks as long as you want to talk about stocks. But that's a group, that's a working list for you to look at. So hopefully that will assist you in your trading and your proficiency and your returns. But I think that gives you a really good beginning part of putting something together. Oh, by the way, I don't have NVO. I just noticed that we bought NVO. That's in the same, that, you know, that's in NVO has NVO has, they're the manufacturer of Ozempic weight loss drug, and technically look how that looks. Say, look at that breakout on volume. See, look at that right there. And that's our initial position for Ray. We bought it. We bought this yesterday or the day before. We bought it, I think, right here 2 days ago on the inside day, I think, right there. And so it's consolidating. There's the breakaway gap. You know, $479 billion company. And again, you know, Ozempic, these are projected to be the 2 largest drugs of all time. So, you know, it's not a $479 billion company. It's not a speculative, you know, situation.
How about Supermicro?
Man, Supermicro is a wildcat. So we actually did trade this stock. We didn't have that big of a position in it, but we bought this stock the day that it broke out here. And then we ended up selling this stock. I think this day. And right here, we had a nice move here. We bought it back at the 21-day and sold it like right before the earnings move, right before the earnings clobbered it right there. So this was a big stock. It had back here, going back a year ago, it had these triple-digit numbers. You can see where numbers are a little bit lumpy now. See the earnings numbers where they were 0, last quarter, 34%, 5%. You actually had what got us in it. See, back here in last April. See, this is after the December 22 quarter, up 270. So you had like a couple of quarters where they were triple digits, right? That coexist during this run here. Then it got sloppy and choppy, and now it's coming all the way back. So it is resetting its place, but there's no accurate pivot. You know, if you were watching this stock, you know, you potentially could have, you know, had a somewhat of an early entry 4 days ago. But I would, you know, if I'm trading that stock, I'd sell right into this and then let it set up and put in a pivot. And you do have this 357 to contend with. So maybe it'll pause here and then go sideways. And then on the earnings number, then we'll see if the stock gaps up on earnings. But certainly because it blew up before on earnings, this is one that you definitely could not hold into the earnings that are expected to be announced in 21 days.
Roy, I see you got out of the TLT. So
Yeah.
Just so a lot of it getting more into growth now.
Yes. So we actually had a 13.5% gain in TLT, and we ended up, we sold half, and then we sold the rest 2 days ago. One day, 2 days ago, we sold the rest. And just because we think there's better opportunities now for, like, if you're a conservative investor, and there's no reason to sell this because you had 13.5% plus it's paying you 4%, you know, so that's 17.5%. We had a 10% position in it. We had a nice position in it, but we think there's these stocks that are being revealed now. We think they have more upside, and like we're talking about CanSlim, but like if you had a broad, you know, I mentioned mute that. A couple of months ago, we talked about, you know, I had like this indicator that I talked about. It was called the mama indicator. That's when you put your mama in the S&P 500 and the TLT, you know, right there. And we don't really believe in a model portfolio where you just have, you know, 60-40, you forget about it because, you know, bonds, you got crushed in bonds. It's a matter of timing, and bonds had the most devastating drop in history. And so the whole way down, bonds, you know, your bonds dropped in value, but, you know, we bought it like exactly right into the teeth of that drop. And then we just got that 2-month rally that we sold into. But, you know, if like we do have some conservative retirees that we still hold this for, and we'll continue to hold it because, you know, we have 13.5% appreciation, plus we're getting paid 4.5%. But we don't want to get stuck in bonds when, you know, when we're trying to find the next Amazon or NVIDIA, for example. I mean, you're not going to make 100% here, but you can certainly make 100% in NVIDIA in the next 12 months, you know, if things go well.
Right.
What about getting TMF instead on this one, the triple leveraged?
What? Pardon me. What was that question?
The triple leveraged one, the TLT triple leveraged is TMF.
Oh yeah.
What are your thoughts on this one to get some faster moves? You know, I guess shorter trades as well.
Yeah, you can. I mean, you can certainly trade it. These, you know, these stocks 3 times the index. I mean, this is, and you know, I don't especially like the triple leverage because they've got what's known as decay. What's that?
The contango, the case.
Yes.
Yeah.
Yes. So they've got that. So, you know, so the anomaly is this, for example, what is the 3-time NASDAQ?
TQQQ.
Okay, so let's take a look at the TQQ versus the Q. So the QQQ, and I just want visually just take a look at what it looks like. So there's the TQQ, excuse me, the QQQ. And notice how strong this is. Now look at the TQQ, and maybe I can overlay it too. I mean, you're not actually it's doesn't appear as bad QQQ.
Go on the weekly, Roy. It shows it better.
And so here's the QQQ, and let me see if I can do the comparison TQQ and then with the TQQ.
TQQQ is a favorite of Dr. Wish.
Yeah, I mean, you know, it's I mean, I have traded it. You know, I've traded it, but this is, you know, this is closer perceptibly here. If you look at the difference here, 125 to 150 versus 175 to here, this is the TQQ, obviously, because it's 3 times, you know, it's going to be more. Oops.
Well, if you go back on MarketSmith and compare exactly what you did with the Q and the TQQ, you'll be able to see the difference there. If you go on the weekly chart.
Okay, let's go to the weekly.
And it shows you're clearly at all-time highs on the Qs. Now, if you go to TQQ now.
Oh, that's exactly. That's what I was getting at right there. So so look at this. You would think that this would, I mean, that the TQQs, which is 3 times, it should be at, you know, it should be near all-time highs. Look how far below, look how much this is underperforming because of the derivative stuff. So, you know, so all this stuff it's okay, particularly to hedge your portfolio and from a short-term perspective, but you're losing and you're paying for that. And that's what you're paying for. So there's the difference. This is near an all-time high and the TQQQ is not. So you can't say the TQQs should be at 80 and they're at 49. That's just the difference because they're taking out all the fees and the decay in the product. So it's not efficient. You know, it's not efficient. It's much better. Guys, it's much better if you want, you know, turbocharged situation, margin this, you know, take the Qs and margin it versus buying the TQQ. That works out better.
I've always found on short trading moves that the triple leverages are great, but you're going to need them to move whatever direction you want it to very fast to get that maximum punch out of it, right? Kind of thing. Otherwise, it's something you're going to sit in. It's not working in your favor whatsoever.
Thank you, Brent.
Yeah. And as far as the TLT, I mean, the Fed starts cutting rates this year. Isn't that supposed to be back to like a, I don't know, 2021 level, 2022 level? Basically could potentially go to, I don't know, 120, 140 on TLT. And if you get, let's say, triple leverage, that's also supposed to go there at that point. Am I thinking right? Or
well, again,
we're definitely going there, basically, kind of like it's what I'm thinking on the TLT, because it's reversed. I mean, inverse to the yields, right?
Yeah. It's gonna be interesting to see what happens with bonds when you have when the Fed goes to an easing cycle where they're cutting rates. But I think there's gonna be, I mean, can the 10-year, can this go down to 3%? I mean, you've got big support here, and we might be in an environment where where inflation is going to be real sticky, and it's going to be, you know, and there's going to be that spread of 2% between the 10-year and where the Fed funds are. It's between the government mortgage market and the 10-year. So that's going to be interesting to see what happens when the Fed, when the Fed lowers rates, because the Feds, they're not lowering rates to like 3%. I mean, we have it, or 2% anyway. I forget where Wes had us, but that remains to be seen. I'm just not sure on that, but I mean, rates will if rates do go to 3% and we're not in a recession, that's going to be very, very, very bullish to the market. Now, incidentally, you do know that many times when the Fed is lowering rates, that's because we're in a recession. And in 2003, when they lowered rates for the first time, the market sold off heavily. We had the next leg down. Same thing in 2009. So just because the Fed lowers rates doesn't mean that it's going to be bullish. But if they do it in a manner so that it doesn't put us in a recession, that's going to be very bullish. But if this market comes unglued like quickly, and like Keith McCullough thinks that the environment is going to come unglued in January and February quickly, and I just don't see it happening. Just don't see it. I just don't see it. This is like moving the Titanic. It happens it happens slowly. And I just don't see something like that happening fast. We've got a pretty robust labor market, and jobs are still plentiful. And we think that advances in things like artificial intelligence and innovation are going to drive these individual firms moving forward. Companies and AI is the place to be, from anywhere from ServiceNow to Datadog to to these technology companies, Dell. This is where the money's going to be made. Security companies, that's where the money's going to be made. Software and semiconductors should lead the market in 2024 based on the earnings visibility and how big it is and how important it is in our economy.
Hey, Roy.
Yes.
This is Tom. Hey, going back to that whole Novo Nordisk and Eli Lilly discussion, I noticed Dexcom was coming out of a perfect cup and handle. I was kind of curious to get your take on the volume signature on the breakout on that.
On Dexcom?
Yeah.
It's interesting. We met with prospect today. She's in she's in a beginning company, a company that they're developing a new insulin pump. So you got Insulet, you got Dexcom, and you got Tandem, really, that are sort of in this group. And this stock had really good numbers. You can see Dexcom, and we own this stock. And in fact, look at where the stock, they sold it into the number right there, where it just shows you, for whatever reason, the stock wasn't ready. So this is how the market was treating you earlier. Like, okay, this stock has great numbers. They're obviously the leading stock in the group, the leading company in the industry group by far, the leading stock. And then they sold into it, the stock dropped. And in fact, I guess one of the reasons the stock dropped, it was attributed to these weight loss drugs, right? Like, weight loss, these drugs are going to solve everything. You're not going to need insulin pumps, which is ridiculous. And anyway, this stock, when you look at the stock daily, there's a nice cup and handle. This is really a beautiful cup and handle, as you said, Tom. And there's the breakout. Looks absolutely phenomenal. So, you had, when you're sitting here and in retrospect and not in the heat of the moment, you can see where the trend changed on this cup, where the 10-day crossed the 21-day down here. to tell you the trend is changing, and then you broke back above the 50-day, and then let me see if, yeah, look at that volume. See, look at that. See, that's it. You know, when you're looking at, when you get down to the brass tacks, these are the days that matter. There's institutional support. So, you know, there's institutional support. It's turning. You got this move up. And then, you know, you've had this nice cup and then this handle that's set up here. So this is a perfect cup and handle breakout, Tom. I agree.
What do you think about the volume on the last couple of days?
Volume, you know, it's not great. You know, you would like to see volume at least 40% higher than this. But, you know, just, many times the volume does come in like later. It doesn't happen on the day of the breakout. And the day of the breakout, that would confirm that's a confirming qualifying signal. But and so it really didn't confirm by volume, it confirmed by price. So this is an interesting setup in my view. And I would I mean, it's definitely a buy technically. Stock's definitely a buy technically. If it'll come in, maybe it'll come in and sit, you know, come back to this 126 area, and then volume comes in and confirms. But you know what's nice about the setup, see, is you got the breakout. Now see where it goes, and then you press it, take it out. Now you press it, taking out that pivot right there. And that's how that's how I would handle it.
Hey, man, I appreciate you looking at that, Roy. Thanks, man. I appreciate both of you guys. Appreciate both of you guys.
You're very welcome. Very welcome.
Hi, can you respond to my comment about the ETF HRTS?
HRT.
Yeah.
Okay.
I think it's a new fund. It's a fund company, Tema.
Do I have that symbol?
HRTS should be correct.
F is in Frank.
No, H is in Harry. R is in Roy. T is in Tom. And S is in Sam.
Sam.
Yeah.
HARN.
No.
FAFS.
No, you want H for Harry.
Okay. Keep going.
R like Roy.
Okay.
T Tom. S Sam.
S is in Sam.
Yep. Samuel.
Okay. Ooh. ETF vascular. Getting feedback. I don't know anything about it. ETF. Don't know what they're in. Long-term growth capital. Just the trading histories, Elaine's not long enough. It's just, you've had this nice move, it came at a great time, like right at that November bottom, and it's just wedged up. So I don't have any opinion on it. Have no idea.
Not very liquid either. 24,000 a day.
The company has a website. They have other pharmaceuticals, biotech on it. So I just thought it looked interesting. They've been mentioning it on the Market Smith videos that they do.
Okay. It's a very illiquid 24,000 shares.
Good point.
Hey, Roy, can you look at TMDX?
TMDX.
T is in Tom. T as in Tom, Transmedics.
Oh, yeah. Interesting. So you look at, you've got a nice little cup and handle forming here too. So, you know, what's interesting, I like the technology. It's not profitable. It's not profitable. This is, I mean, this is a terrific candidate for a buyout, although you would never, necessarily buy it because it may never be bought out. Plus it can languish forever, but their technology is very good. You can see that the stock got hammered from, 99 to 36. And that's what happens when these cup and handles see, a lot of people, get decimated buying it all the way down until, you have to wait until the turn. And, now you've got that cup and handle, and volume did come in. Nice volume today. Volume's up 38%. You want to see that around 40%. So this is one that's been corroborated with the volume, which is excellent. And it's turning into a nice technical setup. And you have got pretty tight there.
So let's get to it.
Hi, Roy. Could we look at Pure Storage, please?
PSTG.
Yes.
Marking time. So you had, obviously you had some distribution that took place. So numbers are, the numbers for the last quarter were decent. In a decent industry group, it's in the top 40. Earnings are going to be up only 3% this year, so that's sort of lagging. Earnings are going to be up 12% next year. Relative strength is like right on the cusp, above 80. So, I wouldn't touch a stock below, an 80 relative strength. So it's right on the, right on the cusp of the lower boundary of what you would require. And but you did have some nice accumulation, big accumulation, largest volume since the base breakout. So something happened right there. So, indeed, this was something happened right here. So when you get situations like this, I mean, I screen for volume, and then you go back and you see, well, I read the news like, well, what happened right there to determine if it's significant or not? And let's take a look. See, weekly, you're in this long base. See, this looks, this looks like this stock is just, when you're on the weekly, it's just basing. It looks like tight. It's been in this almost year base. So technically what you want to see, and now it's tightening up. So you want to see this stock break out of this base here. And when the stock breaks out, then I think game on. But look at this on the weekly. This is the largest volume in the last couple of years, number of years. So something that's important. Something's going on right there. So you might be on to something here, right here. You get through this area here, and there's very little upside. Excuse me, very, very little resistance on the upside. And I'm trying to draw.
Thank you.
Right there. So, you've got a good eye. So you've got a very good eye right there. I'm gonna put an alert right there on it. Yes.
Hey, could you look at two stocks for me, please? The first ticker is N as in Nancy, SIT.
This one?
Yes. Yeah, I just
upon looking at it, my first thought is an excellent chart. And I mean, look how orderly that is with the stair step, and the pullbacks are, that's pretty significant. But in the whole, depending on where you got it, where you bought the stock or where you buy it, that means everything. So,
Yeah.
you know, if you bought this stock here, you would have been stopped out. But look how tight it got here. Then you got the shakeout, which is nice. And now you're having this VCP. See this VCP from here to here. Then it's lower from there to there. Then they got tighter there, and then the breakout right there. And then you've got this drift up here. Nice volume right there. So technically, technically the stock looks good, and distributes brand name information technology hardware. So it looks like they're a distributor. And let's see, weekly, nothing wrong with it weekly. See, look how tight it looks weekly, looks great monthly, but it doesn't, it's not one of these stocks that has powerful earnings. But it's the kind of stock where, if you buy it right and depending on how big a part of the portfolio it is, it looks like it's working its way higher about every 4 or 5 months, but you have 4 or 5 month lags in between before it makes the next move up. But it's in this long-term uptrend for sure.
Okay. I'm surprised you didn't mention IoT in any of your list.
I own IoT myself. I don't have it because it was the numbers. It's an $18 billion company, and it pulled in, and the stock bounced, didn't get it the 50-day, bounced. But I like it, particularly when you look at the monthly and the weekly on it. But the numbers, look at the numbers: 4 cents, 1 cent, minus 2 cents, minus 2 cents, 1 cent. Now, and look at this also. It's only doing 200 million a quarter, 246. So it's doing less than $1 billion, but the market cap is 18 billion. So that's got me hoodwinked a little bit. Like, is that the best merchandise out there? Although that's what got my attention, and I do own this stock personally.
Okay, I got stopped out of this one.
And I haven't been stopped out. But look how it looks. See, on the monthly, see it's in this digestion phase, and this has got that signature of a number of these stocks that I've talked about in the past, where you have the IPO, it goes straight down, and it's one of these IPO stalwarts that gets crushed, comes all the way back. Now it's at this all-time high period, and it's just consolidating. So the $18 billion market cap, see, on another level, that's telling you something. Why is it valued so expensively? Like, man, it must be good. That's the positive that I get. Look how nice it looks here on the weekly. So this indeed, this has got my attention for sure. And I bought the stock like in the last week or so, maybe like 3 days ago, 4 days ago, or maybe I bought it at the 21-day even. I could have bought it. I think I bought it personally right there on the pullback to the 21-day. Haven't stopped myself out, and I'm sitting with it. But those are my thoughts in terms of why is it going. But you look at it on the weekly and monthly, like this is where big winners come from. So definitely keep your eye on it. And it's on the watch list. It's just I haven't pulled the trigger from the buy perspective yet. For in a more calculated, larger manner.
Got it. Another good one is Fresh as well. FRSH.
Yep. Really, there's not a lot of people that know about this company either. Freshworks, it's in the enterprise area. Earnings, it's one of these smaller. and I'll pull up GitLab. I'm sort of interested in GitLab as well, but you know,
Oh, yeah.
133, 137, 140. So it's got modest revenue growth. They are profitable. You know, they're not taking over the world, but you know, again, one of these IPOs that, you know, so you have the IPOs that got crushed, and now it's in an uptrend. So it's, you know, it's a turnaround situation, you know, from 50 all the way to 12, you know, down 80%. Now it's recovering. And I don't know if it's got the horsepower to, you know, to be a, you know, great market leading stock, but it, you know, it's a turnaround. It may or may not work in a big manner. I don't know enough about it, but
Yeah.
I am watching it.
Okay.
Microsoft is.
Right. Did you ever take a look at the Match Group? Do you think it can survive a recovery?
Yeah, I do. I mean, I think you know, any company essentially can survive, you know, a turnaround. That's what makes some of these turnaround situations. Bill O'Neill found that, you know, 2 out of 10 stocks that turned into true market leaders were turnarounds. I mean, when Tesla dropped from 180 to 70, then that was a turnaround, you know, from 70. So it survived and thrived, but it had the company behind it. I mean, it had the products, the product, then the revenue growth and the earnings behind it. Yes. So any of these companies can. So, you know, this was a hot stock. This is just one of these turnaround IPOs. And my contention is that many of these stocks are going to, they can be potential new market leaders. You're not going to find Google and Microsoft and Netflix and Amazon. You're not going to find those stocks double this year. You know, you're going to find stocks like this that have underperformed you're going to, and it might not be in your bailiwick, but going back, I assure you that you're going to find some of these, you know, even, you know, it could be in the Chinese market, like Alibaba, that have underperformed for 8 years. I mean, when is this going to finally turn? I mean, this has been an 8-year, you know, nightmare where, you know, it hadn't done, you know, well, actually you had that big move from 15 to 18 and it's rechecking 8-year lows. So when are these going to turn around? You know, Baidu peaked. This is you know, this stock hasn't gone anywhere in 15 years. And this was a stock that I made, you know, a lot of money on during this 2007 phase way back here.
Sorry, if you go back to Match, is there anything concerning like debt level or anything like that?
You know, let me see you know, O'Neill and I mean, O'Neill, we really don't, that hasn't been, that hasn't been one of the criterias that has impacted whether or not a stock was a true market leader or not. The debt level hasn't been a factor before. So I never look at debt levels, nor do I look at PEs, nor did O'Neill look at PEs, because the great growth stocks are never cheap. You know, they always have an astronomical valuation based on a PE basis. You know, Google and Amazon, they were never cheap. You know, when they went through Tesla didn't have a PE for years. Well, because they were losing money, but yet the price went up. And with that, let me just segue into, you know, CanSlim is just, it's a framework, guys. You know, when you're managing real money, you know, and you do this for a long period of time, and you know, things change. This was, you know, this book was written in 1988. Book was written in 1988, and a lot of things have occurred in terms of technology and innovation since, you know, 1988. We didn't even have the internet back then I don't think, really. And subsequently, like we have found that in the last 20 years, many of the great performing stocks, it's revenue growth that's the most important. So sometimes you have the magic elixir where you have earnings growth and revenue growth. Other times it's revenue growth. And so you can't put everything in a box and check all the boxes and it'd be the perfect setup all the time. So all the time you don't have all the criteria. If it were that easy, everybody would just formalize it and AI and then boom, and everybody's rich. It just doesn't work that way with algorithms in the market and the way the computers work. So revenue growth, I found that's revenue growth and relative strength. That's the most important. Relative strength by far is the most important criteria to look at. Those stocks where the relative strength line is making new highs, and those are the leading stocks in the market. And so the new high list and the relative strength list, that should be your watch list and your buy list in most cases.
That's fabulous advice. Thank you.
You're welcome.
Roy, quick question. What about HubSpot?
Love the company. It was this was an expensive software company that's had, let's take a look long term. And this is, you had this nice little breakout. Look at this sideways. See, this is, we're gonna have some of these guys, IPOs that go into the advanced phase, consolidate, and then break into new highs. And that was in 2018. Stop. And I'm pointing out something that when I'm long gone from here, this is going to continue to repeat. You can see the green line breakout there, 60 to 600. And so by all practical purposes, all you had to do is have all your money, right there during that period. You got the right stock. But, when you go through these corrections, like 200 to 100 down 50%, I could never survive a 50% drawdown to keep me in something, where it drops 50%. Even Amazon, if we look at Amazon during the 2007 to 2009 market, I think it was down 90%. So it's tough to stomach that. But anyway, back to HubSpot. It was a leading stock. You can see this stock is really sort of a nice little cup and handle here. Their leading stock in terms of their software product and what they provide in terms of inbound marketing. And inbound marketing is different from your traditional marketing where you interrupt people and cold call and do that stuff. You provide useful information, drip on people, and then they, then you provide them research, things like that, and they eventually become clients. That's the secret of inbound marketing. And they have the whole process down to an art. And they are definitely the leaders in doing this. I think they're one of the best marketing groups on the planet. And we don't use it. We don't use them, but I'm very aware of them. It's setting up this nice cup and handle. It's let me see, $28 billion company. Definitely looks interesting. So look at the last 4 quarters. That's why I said, as I screened through all these companies, software and semiconductors, they have the numbers that justify the multiples, in my view, and great numbers here. And you can see you've got a nice pivot right now. See where it, came up to that 581 area. Now it's consolidating, and it's one of these. The second mouse is going to probably get the cheese here. And, the stock looks very interesting, looks excellent. And earnings are in 35 days. It's a great price, $60, $56. that could go to 100. So a $500 stock can go to 1,000. It looks very promising. Great numbers this year. Definitely should be on a watch list, buy list. It looks great. Thanks for bringing that one up.
Do you think it has potential of doubling in the next couple of years?
Let me look at it on the monthly, see what it looks like technically. Yeah. So, just look on the back of the napkin, Wes, who's a chartered market technician, will tell you this, that you get the move from the high to the low, and you take that difference, that decline, and, technicians measure that. So that's from 800, it looks like 250. And that's what 6 to 250 is, that 650, 750, 550, 656, 550. So this suggests that this is going to be a $1,300 stock on the next move. We're talking about multi-years on that, multi-years. That's not going to happen, but we're talking about getting a move like this, see, a move like that, which lasts a couple of years. So it's got to get to, it's got to come make all its way back to new high territory and then go. So technically, and this would be considered a turnaround situation too, from a price perspective. It got clobbered. Now the business is supporting the multiple, and so looks excellent.
Mm-hmm.
Yeah, looks excellent. The group strength is poor right now, 132. So that's kind of weighing on the stock a little bit, but it's on a promising note. The float is only 47 million. So that's one of these supply characteristics that's noteworthy. Stocks like this, they trade that are thin. They have the potential to really move. Like, for example, I'm surprised, MSTR, which is a sort of benchmark of course, for Bitcoin. And look at the float on this stock, 11.7 million shares. So this right now, this might perhaps be one of the best ways of playing Bitcoin. See, from this, when you get a thin stock and it goes to new highs, what can happen? This was my biggest winner in 2020 right here. And I own this stock, made a huge move on this stock from, the stock broke out, like it went from 200 to 1,000. And then it went parabolic, and then, went dormant that's been for 2 years. But what moved the stock is the float, the supply, the number of shares outstanding. And what happens is you get in a situation like that, they turn into like those meme stocks like GameStop and some of those, where they trade multiples of their float, and that the buying pressure, people are short it because of, quote, valuation, but they get trapped when the stocks are at new high territory and you don't know where they can go. And it's just pure momentum, pure rocket fuel. And that's where people that are short go broke. And this is perhaps the most leveraged way of playing Bitcoin for those that are so inclined, showing down $10 after market down 186. But, again, we don't know when they launch the ETF, are they going to be selling on the news in the next couple of days, or what? Are they going to be buying it? So it's coming into the 50-day. So I would definitely watch this for those that are so inclined, that embrace, risk and returns, and can, when it's never too hot in the kitchen. It gets too hot in the kitchen for me sometimes.
Hey, Roy.
At my age. Yeah.
When you did the Chinese stocks, you didn't mention PDD. Have you looked at that in a while?
Yeah, PDD. Man, I have owned this stock. This is the leading Chinese stock out there.
Yeah, today it made a new high and then it came back down.
So it closed up 3 today, 150. So This stock's a buy technically.
Yeah,
I don't
if you
own
look
it.
at the
Yeah.
contraction there, like it got real tight for several days or several weeks.
Yep. This might be, no, you know, again, I'm not providing any investment advice, right? But I'm watching, you know, I'm definitely watching the stock. The stock's a buy technically, taking out that one. It's a buy right here, 150.67. It's a buy. So you could know if you enter this position, like based on this chart, the way it looks, you know, you would use yesterday's low for your stop. So, you know, you can buy this stock, you know, here, you know, I watch it intraday to see what happens intraday. But if it takes out yesterday's low where it had support and right there, that's one of these that you can have a real tight stop. Now you may choke off the trade. If so, you could use right here, 140.
Mm-hmm.
Which still is that's probably like a 3% stop. And that's, you know, so that's definitely acceptable. So if you're willing to give it that far, you would hold that until it breaks that level right there. But, you know, it's a buy right here at 150.67, which it probably hit.
It hit today, yeah.
Yep. So it
Yeah, it went
triggered.
to like 151.15 today.
Okay, so let me look at this on the daily. Yeah, see, and people, you know, see, that's what happens. See, people saw it. See, you know, people are aware. See, they're aware of this. So they're aware of these levels. There, you look at where see where the institutions came in right
volume
there.
was heavy.
Yep.
Today. At that
now
time.
notice, and then then the stock came in. Now notice here, look at the buying here at the end of the day.
Yeah, that's what I saw at the end of the day because it was coming back down, and then I noticed it pushed it up at the end.
So think about this. Look, people are out here to take money out of your hands and put it in their hands. So this is how sneaky it is. And here you had the 151 breakout that they sold into, came on down, and then somebody bought right here at the end of the day. You bought a big position in it. So this stock is a buy, and of course they own TMU. And TMU is taking over the world, so to speak, in terms of their internet. You know, they're a Chinese internet Amazon type company, and there's the breakout on earnings. And it's rare. It is rare that you have only one stock in an industry group that's outperforming. Something apparently, obviously, is going on that's not going on in JD, Alibaba, Baidu, etc. Something unique is going on here. So, I'm not a great fan of China either, but that action is quite bullish. I'm watching it, and I have tried it like in here, but.
Roy, what about H? I know it's a whippy one, but looks like it's trying to make a right side of the base on the weekly chart.
What's the symbol?
H, SELH, Celsius.
Oh, Celsius. I actually bought Celsius today personally.
You buy over 60 at the 60 point?
I bought it on the open, taking out yesterday's high. And this is so I bought this stock at the open.
I bought some yesterday on the bottom on that sell off there. Just right in that little sell off there. And
let me pull it up. So I did take a position. Now the numbers on this stock are incredible, fundamentally, and I have this in my refrigerator.
It's everywhere.
Yeah, I mean it's everywhere, and frankly, these numbers are enormous. You know, 137% earnings growth, 300, revenue growth accelerating. O'Neill, by the way, found out that from his model books, the studies show another characteristic. Stocks that have accelerating numbers, earnings and revenues, like 3 consecutive quarters, but they turn out to be big market movers. That's the criteria before they move. And look at the last three quarters. The acceleration of 178 million, 259, 325, 384, and you have an easy comparison see coming also. So keep that in mind, that you're going to probably have another 100% quarter in revenue growth, and then probably another 100% quarter here for the next 2 quarters. And so think about that in terms of, thinking about the comparisons that these companies have in the future. And so this company should have easy comparisons. They just had a 3-for-1 split. And the stock, normally in old days, that, the stocks would move on that. And for whatever reason, this stock has just looked pitiful since it's peaked right here and then sold off. But, I drew this trend line. I drew the trend line, right? You can see the trend line. And there's the buy where I'm looking at it, and I almost bought it on that day. But I have noticed that a lot of these stocks that break a downtrend line one day, they get you in, and then they pull the rug out the next day, which they did in this fact. And then even see yesterday, it was looking horrible at the bottom, looking looking poor, and then it closed well, and then it followed through today. I thought the move was on. We'll see. But it needs to hold this low right here. It needs to hold the low here and not come all the way down, or it'll just be another futile exercise of trying to make money off of Celsius again. It looks quite interesting on the weekly. Look at that on the weekly. It looks great. Looks great on the weekly. Monthly, look at this green line breakout. Look at that green line breakout back in 2020. Boom, boom. And, it looks good on the weekly. The daily is somewhat suspect, but it still looks good on the weekly. So the numbers support a higher price. It's a great product. Love the product. It hasn't been acting great, but it tried to go, and I'm watching it carefully to see if it'll tighten up. Now what it does, if it'll tighten up and you say you own it or you're watching it, just let it tighten up. You let it just go sideways. And now, then we're going to have a pivot to play when it takes out. I'm going to put an alert, see right here at 60.71. Set alert at 60.71. When it takes that out, game on. So right there, if it gets through this and reverses, then you can be likely assured that the move is going to go. It tried to go, they sold into it. Now the next move should be the real deal. So thanks for bringing that one up.
Hey, Roy.
Yes.
Do you ever look at AMD? I know people talk about NVIDIA.
Yeah.
It bounced off that 21 day, and it's basically doing the same performance as NVIDIA almost as a percentage.
Yeah, AMD, the biggest competitor, they're launching their AI chip that's going to be impactful for the first time this quarter. This stock was lagging. Look at look at where it. See, look how it broke this downtrend line and then totally failed, and you got faked out because that's a legitimate buy signal right here. Breaking this downtrend line. You got stopped out, and then you had the stock rallied on very poor numbers. So the numbers weren't great, but the stock rallied. So that sort of told you something. See how I have this pivot drawn here at 111.31? That's when you knew the move technically could take place. Right there. And it's definitely improved in this group. There it is on the monthly. So
It's almost at all-time high.
Look, it looks good. I mean, I would expect this stock to perform well in 2024, and they broke the downtrend line. Weekly looks excellent. In that group, you got Avago, AVGO, you got Broadcom, looks great. And, definitely a leader. And, I try to get just the, if you only have a certain amount of capital, my experience is you want to try to find the real leader. And normally you can have two or three. Like, remember in the 1995 to 1998 to 2000, you had America Online and Yahoo, right? And so you had two, and then you had maybe Time Warner, I think, that was trying to launch a product. But you had, normally you have two major winners in an industry group, and in the insulin area, you had Dexcom and Insulet. You have like two big players. Like in weight loss, we're talking about NVO and Lilly. No, the numbers do show that the difference in performance if you have the number one stock in the leading group versus number two, is substantial. It's significantly different. I mean, significantly, a huge difference between the number one. It's the differences between looking that analogy when we looked at the TQQQ and the QQQ. That's type of substantial difference when you do not have the leader. But when you have the entire industry group, then you're going to have, you're going to have a rising tide that lifts all boats. But that's not what you should be looking for. For example, never is it right to find a stock, and many people make this mistake. Find a stock, find the leading stock in the group, and then you buy the one that hasn't moved yet, the one that's lagging. That's never been a sound strategy, in the past. But people think that, oh, this stock in the group is cheap and it will play catch up. You do have an occasional catch up move in companies like that, but you'll never be in the leader, and they'll always be an anchor around your portfolio. If you're not in the leader and you're buying the laggard. For example, look at CrowdStrike. There's CrowdStrike. Let's take a look at Fortinet, FTNT. Okay. Fortinet, see where it broke on earnings there from 81 to 56. Fortinet, not a leader. CrowdStrike, the leader. Palo Alto Networks, the number 2 in the group. Zscaler, number 3 in the group. So here you have about 3 that are powering this move up. A buddy of mine mentioned one, like S, not a leader. You want to be in the leader. Try to, and of course, you can make money. You can lose money in the leaders too, obviously, but you have more of a chance of your mistake being covered up with the leading stock than the laggard. Guys, I'm going to go 2 more minutes and then call it a night. And it's been a delightful experience for me. I love talking about stocks, as you know, and hopefully I pointed out some thoughts to ponder, if you will, that may help you improve your investment results. Look, guys like me, man, if you're passionate about something, you continue to learn. I continue to learn, every day, every year. It's never too late. That's what makes this so fascinating, is it's always changing. And like Alex said earlier, there's going to always be potential black swans. And, you know, you have to learn how to navigate through all the cross currents that you're dealt with in the market to succeed. And it's extremely, extremely difficult. It's, you know, been in growth over the last couple of years. It's been extremely difficult to be, to have the returns that typically come, you know, with the market. But that's because the wind has been in your face. And I think looking at the indices, we're only 2 months off the bottom. I think it's going to be the real deal now as this market broadens out. And, you know, you draw those trend lines. You take out this high here. And Wes mentioned that if the indexes come up here to resistance at 34, that's 50%, you know, from here. These stocks are going to double. Like all the stocks that I'm talking about, I guarantee you're going to have a handful of a lot of these stocks that we've all talked about tonight that I've mentioned that we own, as well as many of the stocks that you mentioned. There are going to be some triple digit numbers. And so this is the time. This is the time where you're about to harvest what you sow. So congratulations on that. I'm very excited about 2024, and I wish you guys health, wealth, and prosperity for 2024. Thanks for coming tonight.
Yeah, and Roy, thank you for your time. I know you're busy with your business. I follow you on Twitter, and I've been to many of the IBD meetings, and you do a great job, make it easy to understand. So I really appreciate it.
Yeah, thank you so much, man. That makes me want to come back.
And thanks, Roy. You're very generous with your time, and we all appreciate it.
Thank you, guys.
Thank you, Roy.
Welcome.
Thanks, Roy. Good night.
Good night. My pleasure.
Thanks, Roy.